Ladies and gentlemen, put your hands together for our program director for AMC 2026, global moderator and multi-award winning financial journalist, Gugulethu Mfuphi.
A very good morning to you in Africa, a very good morning to all of you from across the world. What a delight and privilege it is to see so many familiar faces, some new ones, key partnerships, and of course, key collaborators as we gather here for what is the second annual Africa Markets Conference for 2026. Now, much of last year was truly characterized by a level of resilience that we saw when we described activity on the African continent. But this year, the conversation promises to be different. We move from ambition to action, unpacking how best it is that we truly pull at all the levers that will unlock the growth potential that exists on the African continent. Ladies and gentlemen, distinguished guests, His Excellency, the 8th Secretary General of the United Nations, Mr. Ban Ki-moon, Honorable Finance Ministers, Central Bank Governors and Deputy Governors, Honorable Excellencies who are present representing key financial services institutions across the continent, to you mobilizers of capital, captains of industry, governance gurus, reformers of policy, implementers of change, and even our hedge fund heroes in the room. It's a delight and a privilege to welcome you all incredibly warmly to the 2026 Africa Markets Conference brought to you by Standard Bank Corporate and Investment Banking. On that note, ladies and gentlemen, I'm hoping to build up the excitement that we have here in the room. I know that we talk numbers and we talk facts, but the truth is, true to African culture, when we greet each other, we acknowledge each other with a spirit of enthusiasm. So I'm going to greet you one more time, hoping that I hear a resounding good morning from all of you who are present here with us here in the room as we look to build up on the momentum and the energy that we want to possess over the next 2 days. Ladies and gentlemen, distinguished guests, mobilizers of capital, chasers of alpha, reformers of policy, hedge fund heroes, individuals who are shaping the growth of the African continent that influences the rest of the globe incredibly positively. A very good morning to the AMC 2026 conference. I appreciate your cooperation, and most importantly, that is the energy that we look to maintain. I say this because as we gathered here today, many of us are representing different organizations. And over the years, through our levels of expertise and engagements with peers in the industry, one key theme has remained dominant when it comes to the global stage: Africa's role in growing and impacting the rest of the global economy. Today, we look to unpack what this means, especially given the highlights that we've witnessed in the last 24 months. Changes and shifts in geopolitics, whether it be implementation of potential challenges and gaps when it comes to funding, and of course understanding how this plays a critical influence in the world and the realm of AI and growing use of technology that we witness. This just lays a very basic foundation of some of the themes that we look to explore throughout the AMC 2026 conference. We'll hear from various industry leaders, we'll hear from panels, and most importantly, work on forging solutions in unison to make sure that by the end of this year, as we head towards the year 2050, where 1 in 4 people in the globe will be African, that we fully understand the impact and the influence that we have as an economy and economic force as a region. So I'm excited again, ladies and gentlemen, to have you all join us here today for what promises to be a phenomenal 2-day conference. And most importantly, we call for your active participation. I'm aware a few of you are still coming into the room, and we'd like to strongly encourage you to make your way forward. There are some empty seats, even right up to the front row. We promise that doesn't make you a target for any direct questions from our moderators. However, I can't hold that true to the theme of the full-day conference. We do want to strongly encourage you to engage and actively participate in many of the conversations and themes that we will be discussing. And perhaps just to whet your appetite as to what themes will be explored today and over the course of the next 2 days, we're going to fully unpack and entrench ourselves in unlocking the levers that help us fully understand how we turn infrastructure into bankable assets, accelerating the energy transition with Africa at the center of empowering industries, deepening and unlocking our capital markets as a key priority for opportunities to access financing across the continent, fueling intra-African trade and building regional resilience, and most importantly, reframing sovereign debt. These are some of the topics that will be discussed and addressed throughout the course of this conference, and I do believe it comes at a very poignant time if we consider just some of the news headlines that we've witnessed here this morning. Across the globe, uncertainty remains, whether it's the moves that we see in the commodity prices, which continue to be bolstered by the potential threats of conflict between the US and Iran, understanding the outcomes of the Supreme Court in the US regarding Trump's positioning on tariffs, and even those very same tariffs which actually face another potential increase from 10 to 15% over the weekend. But outside of the dynamics that we see regarding the US and its global influence, we also need to be mindful of the partnerships we have with our colleagues and counterparts, not only in the East, across the rest of the continent, but also the growing influence we see coming out of the Gulf, whilst maintaining the partnerships that we also have in Europe. So the opportunities are broad. Threats and concerns do remain, but most importantly, it's how we propel ourselves to navigate these opportunities that we'd like to tap into. So I'm hoping that you're all looking forward to the two-day conference that we have today and excited to hear much of your feedback. I do want to strongly encourage you that it's going to be very interactive, where you'll have an opportunity to engage with the panelists and panel discussions and various speakers who will be on stage throughout the course of the 2 days. One thing that we are aware of as I moved to the house rules is that you all play a very critical role in keeping our economies going. And that means you need contact with the rest of the world. So we'd like to just announce that we do have Wi-Fi that is available. The Wi-Fi password network is also available on screen. Please do make use of the Wi-Fi network. It is safe and secure. Outside of that, it also affords you an opportunity to engage in several of the Mentimeter questionnaires that we do have available throughout the course of the conference. Beyond that, we do kindly request that you keep your cell phones on silent just to minimize any disruptions towards your peers on stage. And understand that we're not anticipating any emergency drills today. So if you hear a fire alarm, please do take it very seriously. Follow through with the emergency exits, as well as the emergency exit protocol that will be directed by leaders of the event, rather the venue that we're present at today. We're also well aware that we have participants who are joining us online. To those of you on YouTube as well as LinkedIn, we welcome you, and you too are more than welcome to share your feedback with us as we engage with leaders from across the continent and the world to help us unpack some of the critical themes we'll discuss today. I must say, I've been told that we have at least 14 countries or more that are represented here in the room, and perhaps just to feel the sense of where we're coming from and, of course, the level of excitement. Any of you visiting South Africa or Cape Town specifically for the first time, by show of hands? We've got quite a few. Okay. So we know where to take you at the end of the day if you missed out on last night's party. More than anything, we've shown you that South Africa and Africa as a whole really has an energy, a vibrancy to making sure that we're able to build on the relationships we establish. On that note, perhaps to begin us off on the formalities of today's program, to help solidify the messaging that we look to underscore as we move from ambition to action, allow me to warmly welcome to the front of the stage, ladies and gentlemen, an individual that many of you are very familiar with. A leader in his right when it comes to banking and financial services, but also playing and serving a critical role in making sure that as we are gathered in the room, we understand that it's not just about the unlocking of capital. That's critical. However, what we're here to establish and provide, largely through the leadership of Standard Bank Group and Standard Bank Corporate and Investment Banking, is understanding that we're providing an interface of increased interaction, where desired policy reform shifts to become a market reality. To help us expand on this topic further, and most importantly, warmly welcome us to AMC 2026, please warmly welcome to the front of the stage, and perhaps I need to add a disclaimer. When I say warmly, in South Africa, we like to work on levels. You might have been present last night and noticed that sometimes technology is a great friend, but it can be a fickle friend. But there's levels to themes that we have, whether it's load shedding, whether it's a water crisis, whether it's the kind of funding we need, or even sovereign ratings. So what I'm looking for in terms of our applause and welcome for our guests and our speakers here today is not a C- credit rating, We're looking for some optimism and enthusiasm and warmth in your applause. So perhaps we need a practice round, or maybe you'll do justice to our first speaker for the day. But what I'm welcoming you to do is to warmly applaud, to welcome, to accept, and most importantly, true to African form, perhaps some ululating is also accepted. So ladies and gentlemen, as we welcome our first speaker to give us our opening address for today, please warmly welcome to the front of the stage the CEO of Standard Bank Corporate and Investment Banking under the Standard Bank Group, Mr. Luvuyo Masinda. There we go.
Thank you very much, Gugulethu. I think that felt like a A+. His Excellency, Ban Ki-moon, Honorable Finance Ministers, Central Bank Governors, and Deputy Governors, Excellencies, distinguished guests, colleagues, ladies and gentlemen, good morning. On behalf of the Standard Bank Group, it is my great privilege to welcome you to the 2026 African Market Conference here at the Novell Foundation Art Museum in Cape Town. And what an incredible venue this is. In less than a decade, this space has helped reposition Africa contemporary art from the margins of the center to that of the global conversation. This foundation represents infrastructure catching up with talent. And it's an apt venue for us to be hosting our second AMC conference out of Cape Town. The objective of our gathering is straightforward yet ambitious: to facilitate solutions to how global capital can be mobilized at scale to support Africa's structural transformation. The global environment is undergoing material change. Geopolitical fragmentation, heightened macroeconomic volatility, and shifting trade alignments have increased the selectivity of cross-border capital flows. Risk pricing has become more pronounced. Development finance has become more constrained. Capital allocation decisions are increasingly influenced by regulatory complexity, fiscal credibility, and institutional strength. At the same time, Africa's structural requirements continue to intensify. Rapid demographic expansion, accelerating urbanization, rising energy demand, and the need for resilient infrastructure continue to expand the continent's financing requirements. The central question, therefore, before us is not whether capital exists, which it does. The question is whether the African markets can consistently access this capital at scale, at an appropriate cost, and with sufficient depth to sustain long-term growth. Our theme this year of mobilizing capital at scale reflects a structural shift in focus. Scale is not about increasing the number of transactions. It is about building markets that can access capital consistently, at volume, and at competitive cost. It is about the liquidity, standardization, and predictability, the conditions that allow institutional capital to allocate with confidence. In practical terms, this means moving from isolated, bespoke transactions to investable pipelines supported by credible policy frameworks. It means shifting from Africa as a tactical trade to Africa as a strategic long-term portfolio allocation. That shift will not occur through optimism alone. It requires disciplined fiscal management, transparent regulation, credible debt frameworks, robust project preparation, and deeper domestic capital markets capable of absorbing and recycling capital efficiently. Mobilizing capital at scale is therefore not principally a question of global liquidity. It is a question of market design and institutional execution. There are several structural factors that support confidence in Africa's long-term investment thesis. And some of these are, firstly, domestic capital formation on the continent is significant. Estimates by the African Finance Corporation suggest that Africa holds approximately $4 trillion in domestic investable capital. Pension funds, insurance assets, sovereign funds, and banks like ourselves collectively represent a substantial pool of liquidity. However, mobilization remains uneven due to regulatory constraints, limited secondary market depth, and project preparation bottlenecks. Secondly, the infrastructure financing gap estimated at between $130 to $170 billion per year. This represents both a developmental constraint and an investable opportunity set. Transport corridors, power generation and transmission, water systems, digital networks, and logistic infrastructure can generate long-duration cash flows aligned with institutional investor mandates. Thirdly, capital flows are highly responsive to policy credibility. Empirical evidence demonstrates that the consistent fiscal frameworks, transparent debt management practices, independent monetary policy, and reliable regulatory enforcement materially reduce sovereign and project-level risk premium. The implication, therefore, is clear. The mobilization challenge is less about the global supply of capital and more about the quality of market architecture through which that capital is deployed. Last year, the inaugural African Markets Conference demonstrated that structured engagement between issuers, investors, and policymakers can produce tangible outcomes. As an example, the collaboration between BNY, previously known as Bank of New York Mellon, on global depository notes referencing Nigerian securities broadened investor access to local instruments. Engagement with sovereign issuers contributed to renewed international market participation, including structured investor outreach initiatives. The purpose of this AMC is to build institutional continuity. Capital markets develop through sustained engagement, regulatory clarity, and credible signaling, and not through singular events. Allow me, therefore, to outline the role we believe that the Standard Bank Group, and in particular, the Corporate and Investment Bank, must play in this process. Standard Bank is an African institution with global connectivity. Our CIB franchise operates the intersection of policy formulation, capital allocation, and transactional execution. We integrate our solutions within a unified platform. And this integration enables the structuring of sovereign and corporate financing solutions, the provision of risk management instruments, and the facilitation of cross-border trade and payments within a coherent institutional framework. Our scale is material. We maintain an on-the-ground presence in 21 African markets linked to major global financial centers. We hold approximately 1.1 trillion rands in deposits and distribute more than 650 billion rand in advances every year. Within CIB, we serve over 3,000 clients and process an average of nearly 5 trillion rands in payments daily. In 2024, our CIB franchise generated 65 billion rands in revenue, reflecting resilience across market cycles. However, scale is not alone sufficient. The strategic imperative is to deepen market liquidity, broaden investor participation, and strengthen the structural underpinnings of capital markets across jurisdictions. Africa does not require isolated flagship transactions. It requires deep, transparent, and functioning markets. Over the next 2 days, discussions will focus on 4 structural shifts necessary to mobilize capital at scale, in our belief. First, from risk perception to risk differentiation. Risk cannot be eliminated, however, more granular data, improved disclosure standards, and consistent policy communication allow investors to differentiate rather than generalize, thereby narrowing the risk premium. Second, from conceptual projects to bankable assets. Project preparation facilities, credible procurement processes, enforceable contracts, and governance discipline are prerequisites for institutional capital participation. Third, from single source financing to layered capital structures. Blended finance mechanisms, credit enhancement instruments, political risk insurance, and developmental finance participation can de-risk projects sufficiently to crowd in pension and insurance capital at scale. Fourth, from fragmented domestic markets to integrated regional capital markets. Liquidity, harmonized regulation, cross-border settlement efficiency, and digital infrastructure are foundational to capital markets deepening. Regional integration, including through the AfCFTA, enhances market size and resilience. The AMC 26 program reflects these priorities. These are not theoretical discussions, they are operational questions that determine capital allocation outcomes. Ladies and gentlemen, in conclusion, Africa's development trajectory will be shaped by the strength of its institutions, the credibility of its policy frameworks, and the depth of its markets. Natural resources and demographic growth create potential. The strength of institutions determine whether that potential is realized. This conference is therefore focused on practical objectives, strengthening the market architecture that enables capital to flow efficiently, predictably, and at scale. Regulatory coherence, discipline, fiscal management, transparent debt frameworks, and robust capital market infrastructure are not abstract principles. They are the foundations upon which sustainable growth is built. If we advance these foundations with consistency and discipline, the result will be deeper and more resilient African markets. Markets capable of mobilizing domestic savings, attracting long-term global institutional investors, and financing structural development on sustainable and competitive terms. At Standard Bank, we remain committed to partnering with governments, regulators, investors, and multilateral institutions to strengthen these markets. Because Africa is our home and we are committed to driving a growth through disciplined deployment of capital. Thank you, and I wish all of you a very productive Africa Markets Conference 2026. And I hand over back to Gugulethu. Thank you very much.
Thank you kindly, Luvuyo, reminding us of why we are gathered here today and, of course, the ethos within which we need to carry today's messaging over the next 2 days. Much of the engagement takes place between today and tomorrow. However, the action and the items that we need to prioritize will certainly need to be implemented the day after, and making sure that the partnerships that we look to execute on are tangible. So that does give us some perspective as to the conversations that will be taking place, and for us to remember the reason why we're all here. Well, before we move on to our next session, which is going to be even more interactive to provide us with the opportunity to engage on the hindsight, information, data points, and the knowledge that is typically shared in the room, I do want to strongly encourage many of you who are present with us again that it's wonderful, if you had my view up here on stage, to actually see a full house of participants who are with us today, to make sure that everybody does have the opportunity to engage. Throughout the course of the day, when we return from lunch breaks, tea breaks, we do ask that you kindly take up all the seats as possible in the front row of the stage, just to allow that there aren't any gaps, to ensure that other participants are able to have seats throughout the course of the day when they make their way into the venue. So it's a packed house, and that's exactly how we want it, to make sure that we're all able to actively engage and, of course, have opportunities to be in sessions. On that note, though, speaking about sessions that we look forward to, last year was the inaugural Africa Markets Conference. And as you can imagine, there's a lot of perspective that is typically shared at the beginning of the year with any new theme regarding expectations we should look forward to. If there's one job that I wish I had taken a few years ago. Not that it was offered on my table, but I think I'd try my luck as an intern. It's being the CEO of a gold mining company over the last few years. Who would have thought that the upswing in the commodity price cycle, I'm seeing many of you nodding and shaking your heads. Are you in agreement with me? Our colleagues from Ghana, you should be smiling because many of your counterparts are also seeing the benefits here. But this is what we're going to discuss on some of the themes that many of us had not anticipated but have seen a significant level of upswing. Whether it's the commodity prices, whether it's related to the influence of geopolitics and their influence on the market, AI and technology, Mag 7 stocks, questions regarding their valuations, and even just going back to the fundamentals and the basics as to where and which asset classes outperformed their peers in the last year. This is where we are going to class. You and I are going to pick our brains, are going to be probed around a clearer reflection of what evolved over the year of 2025 that could play an influence into the projections and expectations we have for 2026. I'm excited about this next session, and I want to strongly encourage you to engage. You will be asked a few questions, but most importantly, you will also have access to a tool called Mentimeter. To ensure that we're all able to access it, please feel free to actually log on to the QR code that is available on screen. This is where things get fun. So to the central bankers, to all of you as investment professionals, this is where you're allowed to relax and let your hair down a little bit and say, perhaps this is an interesting theme for us to build on. So Mentimeter will direct you to a page where you will be asked a few questions throughout the course of this new interactive session that our next two speakers will direct, and they will give us some insight into a reflection of the year that has passed. Some of the calls that we made that turned out quite all right, and others that perhaps might have been a bit of a blunder. But to help us unpack what this looks like, we have two banking professionals who come with more than 2 decades of experience in leading financial services and banking offerings to their clients. Not only do they cover the breadth and depth of an understanding of client coverage across the African continent, but also understanding how this ties into the global nuances and needs of clients. Please warmly welcome to the front of the stage two key and critical leaders within the Standard Bank Group, specifically under Corporate and Investment Banking, the Head of Client for Africa Region's Global Markets at Corporate and Investment Banking under Standard Bank Group, Mr. Shola Adegbansan, and Mr. Shola Adegbansan. You're going to have to help me. I did it so well when I saw you last night, and now today my tongue is tripping over me. Mr. Shola Adegbansan. There we go. And he'll be joined on stage as well by Mr. Alex Davidson. Alex Davidson, that was easy, Head of Client South Africa Global Markets for CIB at Standard Bank Group. Thank you so much, gentlemen. Welcome.
Over to you, Alex.
Thank you. Thank you very much, Gugu. And very good morning to everybody. And welcome to the second AMC, and more importantly, to our second view from the room. And I think, as Gugu said, Shola and I really like to try and position this morning's 20 minutes or 25 minutes that you're going to spend with us as something slightly more informal and slightly more relaxed. So, kind of take it easy, get your phones out, and let's spend 20 minutes, 25 minutes pretending like we were traders. And, there's an expression that one of our traders uses quite often on our daily trading calls, where he says, there are decades where nothing can happen, and there are weeks where decades can happen. And I don't know how lots of you and our colleagues feel, but certainly at the moment when we wake up on a Monday morning and I finish work on a Friday evening, I can feel that during that week, decades have happened. And so it was very much with that in mind that Shola and I thought it would be a very good idea to go back and have a look at the YouTube video of our session this time last year and try and understand two things. One, I wanted to try and get a sense of how many views we got, and Shola, I was hoping it would be in the millions. It was 181. I thought we'd have multiple likes. There were 2. Shola, that was probably you and me. But what we wanted to really try and understand is the major themes and the predictions that took place last year. So let me give you a little sense. The major themes that we spoke about, all of us in this room last year, was the word that I used, dislocation. Last year when we were sitting here, there was a dislocation. Dislocation in fiscal policy, Doge going on in the US, Europe talking about embarking on a massive spending spree, monetary policy dislocation. The US had just kept rates unchanged at their recent meeting, and Europe were cutting, Australia were cutting, Canada were cutting, massive dislocation. And so, it was a very interesting time. When we think about the themes that we're facing now in 2026, we're talking about very different things. We're talking about AI, we're talking about tariffs, we're talking about geopolitical uncertainty, we're talking about the competition for rare resources and specifically the rare earths. So a year down the line, it's amazing how things can change. Those were the themes then versus the themes now. Shola's going to take you through the market predictions then and how the market has performed since then.
Okay, thank you. Just to point out, this is last year, so don't cast any votes here. But quickly, I'll just go through 4 of the indices we talked about last year. One was oil. Most of the audience last year had predicted that, 60% of the audience had predicted that oil will range between 60 to 80. At the end of December 31st, 2025, oil was at 61.51. So I think you guys got it right. Round of applause for yourselves. The next one was gold, the mother of all movements. But the interesting thing about gold last year is everyone actually, or majority actually, forecasted that it will end up higher than 3,200. But I don't think anybody expected it will go even much higher than that. So on that too, round of applause to the audience. And then US Treasuries. 10-year US Treasuries, 42%. This was quite mixed last year. 42% said it will end up higher than 4.5%, but it did close at 4.16. So I think you guys missed it that time. And the last one was also another interesting asset class, Bitcoin. 50% of the audience had predicted that it will end between 60,000 and 100,000. And our expert said 100,000. But it closed at 87,000. So you still got it right. Round of applause for yourselves. So we'll go into this year's predictions, and now you can vote. And I think, Alex, you'll start with the first one.
Right, so to kick off, we're going to kick straight off with gold. And if you've all got your Mentimeters fired up, those are the predictions we're giving you. So let's see. As you vote, we're going to get some live graphs going. And it's going to give us a sense of where we're going to settle down. And straight after that, we'll go into where our expert predicts things to end.
Interesting thing last year that many people didn't realize. Last year, gold set 50 all-time highs. In 1 year, we touched the highest ever price of gold 50 times. Driven largely by structural reform. And I think the best thing about the price movement of gold was the fact that this wasn't cyclical, it was more structural reforms. And thanks to the central bankers who are here, you were the biggest part of pushing up that price. And if you recall, I did mention last year to the central bankers that a number of central bank governors had asked Standard Bank as to how to facilitate the purchase of gold. So another reason why you should always come for AMC.
Right, so it looks like we're going to settle on the majority of the audience in the range, Shola.
Yes, it seems everybody is still expecting a rally on the gold price. 56%. Nice.
Right.
Okay.
Should we go to our expert and let's see what our expert has to say? It's going to be very interesting.
We have a high conviction gold will end above 6,000 by the end of this year. For next year, our base case is 7,000, depending on your view of interest rate cuts, but we think 3 cuts will get you there, and any further cuts should get gold between 8 and 10,000. So, of course, there are many variables that drive gold, but we like to focus on the primary fundamentals and to ignore the noise around central bank buying and speculative flows. And these primary fundamentals include money supply and real interest rates. There have been counter-arguments that real interest rates are no longer correlated with gold prices, but we would argue they are, depending on the regime in which you measure those correlations. So while money supply increased 50% over the last 5 years, this has supercharged gold. And as we now drop real interest rates, the pricing of gold is now starting to reflect its true value. Of course, there are potential downside risks, including the shrinkage of the balance sheet by the Fed, but that certainly isn't our base case.
So our expert also agrees with the crowd. An expectation of gold rising as high as 6,000. Again, my comment last year to the ladies was that, please buy more jewelry. Use Standard Bank as your excuse. We said gold price will go up. Okay.
Right, we're going to move on to US Treasuries as our next market where we're going to predict. And here we've given you currently US Treasuries trading slightly over 4%. We've given you the three options there, 375 to 425, below 375, and above 425. Shall I worked very hard with you on our ranges this year to keep everybody away from sitting on the fence, but it doesn't seem like we've done a good enough job.
Again, just like last year,
I know, it's
the views were very, very similar.
All right. It looks like we've settled there. I mean, we've got 42% at below 375, which is very interesting. Right. Let's have a look at what our expert junior has to say.
I think the US 10-year will settle somewhere between 375 and 425. I'm calling it 410. I think the 10-year is going to be caught in the tension between monetary policy desires and fiscal realities. While inflation remains above target, it's clearly moderated and is under control. And so it's difficult to see us closing well above 425 unless something goes wrong. We've had 75 basis points of cuts thus far, but I think concerns around the labor market, as well as tremendous political pressure to lower yields, means that the market is pricing in between 2 to 3 cuts. It's questionable on whether that's appropriate or not, but even if it were to play out, I think that will likely impact the front end of the curve. I think the 10-year will likely maintain or widen its term premium, and you'll see a curve steepening, and that's why I'm calling it remaining sort of between its recent range of 375 and 425. But my individual point call is 410.
Thanks, Junior. I mean, that's quite different in terms of where we had the audience. So it's, Junior's got that rate materially higher, which is very interesting. Right, Shola.
The next class, Euro USD. So the story about the Euro USD last year was largely around, it was more around dollar weakness rather than Euro strength. Again, the question this year is, are we going to see a rebound of the dollar, or are we going to see continued weakness of dollar and stronger euro? The ranges here are 1.25, below 1.15, between 1.15 and 1.25. Why do I have a feel this is a safe bet that the audience is making? It seems everybody is forecasting more of the same next year, or this year.
Right, that looks pretty settled. I think let's go to the expert.
This year, I think the euro will end the year between 115 and 125. There are many factors that can cause it to move in either direction. The short dollar trade that we've seen and the trend that we've seen in this for the last few years may be thwarted slightly by the geopolitical risks we're seeing rising in Iran and across the rest of Europe. I think the election risk we see in the midterms in France, as well as in the US, I think could show that in Europe things are moving slightly to the right. And I think the overall geopolitical risk may see a stronger dollar if we see oil move a little bit higher. The countries which will be large importers of oil, which Europe will be, will suffer from that. So in my view, I think we will see the euro between 115 and 125, but I'd prefer it closer to 115 towards year end.
Thank you, Tom.
Thank you.
All right, so that's 3 down and 3 to go. The next 3 are going to be slightly different. So we've applied our minds and come up with some different categories that we thought would be really interesting. And so here we're asking the audience to give us a view on what they think the strongest return in 2026 will come from. Mag 7, the S&P 500, Bitcoin, a basket of critical rare earth minerals and metals, or emerging market sovereign CDS.
Why am I not surprised?
Right, that's maybe one of the first overwhelming ones we've had.
Yeah.
Let's see how that stacks up relative to our expert.
I think a basket of critical and rare earth metals would be the strongest performer out of these asset classes, just given the AI theme and also the midterms coming up, fiscal spending, etc. Just going through each category and maybe a comment on each. Mag 7 equities, I think, are going to underperform given their spending that they've done on data centers. I think they're going to struggle to get those cash flows back, and growth as a factor, large cap as a factor is not going to do well. I think smaller companies are going to benefit more from AI than large companies this year. Even the S&P 500 X to Mag 7, although more interesting, it's still not an equal weighted basket, which would have been more interesting to me. So even that has too many large cap names in there, and there's big concentration in those. Bitcoin's pretty interesting, but it's behaving like a tech stock at the moment, and it's basically following sort of the software ETF almost tick for tick. So maybe later in the year that starts performing. That's obviously the most volatile in the group. And then the least volatile might be, or at least at the moment, would be emerging market sovereign CDS. Although I do think this will perform well, I just think those spreads have rallied quite a lot already. So it's hard for them to outperform something that could have quite a lot of upside in terms of these critical and rare earth metals.
Yeah, that's an interesting one. And the audience and our experts completely aligned in that one.
But be wary of the situations where everybody thinks something will happen. I remember a certain US election.
Right, so two more to go. This is an interesting one. So let me just try and explain what we're looking to achieve here. You've got 5 what we'd consider market truths that have been put up for you to consider. The market truth at the moment we feel is that AI will decrease jobs for knowledge workers. A market truth is that the SpaceX XAI ecosystem is going to have to IPO to generate some cash. So those are all market truths. What we're asking for you is for you to select your contrarian view around which of those market truths do you not feel will take place in 2026. So it's a contrarian view on the market truths. I'm fascinated by this one, I must tell you. So AI decreases jobs for knowledge workers. Very interesting to feel like that may not come about, although it's a massive risk at the moment, and that the war in Ukraine remains unresolved. So we feel that that is a contrarian view. 33% of our audience feel that that'll actually get resolved. Okay? Very interesting. Let's leave it there. I think that's kind of settled.
Yeah,
and let's have a look at what our expert has to say.
The IMF forecast that Africa's GDP growth will be at 4%, and I think they're hugely underestimating what the number is eventually going to be, both for this year and next. When you were looking at Africa at month, 2 months, 3 months ago, you would have underappreciated how much Africa's cost of funding would have dropped and how much capital the continent has been able to attract. The commodity price story has been much stronger than what we had expected. Furthermore, African countries have done a lot on the structural reform side, and we saw a lot of those flows that followed that story coming through over the past few months. So if you think about where we were a month ago, you think about where we were 2 months ago, you probably would have thought that the story would be positive, but not as positive as how it's played out. I think the number is going to be closer to 5%.
Excellent.
That's a contrarian view to the contrarian view, Shola.
Yes.
It's like, Mama is really being contrarian. Not even the audience went with that.
I think our policymakers will be quite happy with that.
Last one.
And the last one. The strongest performance in sub-Saharan Africa. I think what we're looking for here is, of all these three regions, which region do you think is going to perform the best in 2026? Don't ask me, I am biased. Just some quick information. East Africa is the fastest growing region with a projection of about 5.9%, followed by West Africa, 4 point something, and South and Central is about 2.9. We do see that West Africa is driven largely by hydrocarbons. East Africa is driven by the level of diversification of their different economies, so they're not reliant on one thing. And obviously, the most organized is South and Central. Interesting. East Africa.
Yeah. Don't be upset, Shola.
I'll try not to be. Excellent. So let's hear what our expert says.
We expect the strongest outperformance for 2026 to come from West Africa. The continent finds itself in a unique set of circumstances this year and probably for many years to come, where we have a confluence of a commodity boom fueled by AI and fiat debasement, which has supported our trade balances and has allowed us to build up external reserves. A relative reduction in the perceived African risk premium as global policy has become more uncertain has made us an attractive destination for capital and should continue to reduce funding costs, and a number of strong idiosyncratic drivers across many countries across the continent. The combination of which sets the scene for phenomenal 2026 for Africa. That said, while we are broadly constructive across the whole continent, we expect the strongest outperformance to come from West Africa because we see West African markets, specifically Ghana and Nigeria, as markets which have had the strongest instituted structural reforms, have positive exposure to the commodity complex, and have supportive regulatory framework that allows the seamless assimilation of offshore capital into their markets.
Excellent. I think the best thing to take out of this is that across the whole continent, the projections for 2026 are quite positive. And I think this is a time for us as a continent to take advantage, considering the tough periods we went through a few years ago. So I think it's a win for all of us.
Thank you. So, that was wonderful to spend that time with you. I think, we'll go back and have a look at some of those predictions and see how things pan out. And so without further ado, I suppose from Shola and myself, we should probably finish off with our signatory conclusion, which is, that is the long and the short of it. And we thank you very much for joining us, and we'll hand over to the experts. Thank you, everybody.
Thank you so much, Shola and David, giving us some clarity there around the opportunities that do exist for the year ahead. I must say, Shola, I appreciate that you've been very kind in saying the success is for all of us, because true to form, I thought we'd have some audio to say, the emperor, the conqueror, the lion is here. For anyone who's unfamiliar with those lyrics, they actually speak to a very popular song produced by an artist in West Africa, which really speaks to the robustness of just the ethos of carrying yourself with a level of growth and opportunity and optimism. So it's a strong reference to the fact that West Africa is building and, of course, sees some great opportunity and optimism, and perhaps that is something that can resonate with the rest of the regions across sub-Saharan Africa. And that's an interesting theme and point that we need to build up on, right? Given the optimism that we see in terms of growth, what that looks like on the African continent, upwards of 4%, as we've heard, still seeing a significant increase in critical minerals as well as commodity prices. These all speak to fundamental themes that could have an influence on the economies of sub-Saharan Africa. We move to our first panel of the day. This is where you too can engage and ask robust questions to many of the speakers to fully unpack where this opportunity comes from, what it means for policymakers, how it will influence monetary reforms, capital allocation, and key sectors that we need to consider, especially as we want to continue to drive growth. This panel discussion will consist of 3 speakers who will be joining us on stage, all of whom providing us with their refreshing perspectives as we look to the year ahead within the current landscape and ecosystem. This new normal that we've all adapted to. But how many times have we been adapting? So these are just some of the themes that we will discuss with our panelists who will be joining us on stage in just a moment. I do want to also highlight that perhaps to set the tone as to what it is we should be looking forward to, though, we will have a presentation that will be provided to help us understand the dynamics within which we operate. So I'll introduce my panelists so that you are aware of who they are. Following this presentation, though, we will introduce all of them up on stage to actually participate in conversation. However, our first panel is comprised of Africa research economist at Bloomberg, Yvonne Mango, who will be joining us to give us her perspective. We'll also have a well-known leader within the industry of all themes, investments, and economics, Managing Director at Kazi Consulting, Dr. Michael Power, who will join us. And of course, it wouldn't be a conversation on all things to do with economics if we weren't joined as well by Mr. Gulam Balim, who's a chief economist at Standard Bank Group. They'll join us for a panel discussion, but to help us contextualize where we are within the world, understanding geopolitics and the alignment with macroeconomics and how the current status quo might influence the direction going forward. Please warmly welcome to the front of the stage Mr. Gulam Balim, joining us as Chief Economist for Standard Bank Group, following which we'll have our panel discussion. But a warm welcome, please, for Mr. Balim.
Thank you, Gugulethu. I've been afforded a few minutes to preface the impending panel discussion with some steer on this new world order. Geopolitics is no more a background risk. It is now at the core of decision making. I think many would concur that while historically we would lean towards economic data to make decisions, now one also has to incorporate political intent. Mark Carney, about a month ago in Davos, was quite abrupt. He said the quiet part aloud. He signaled this is not a transition. This is a rupture. And we interpret that rupture to mean that from yesteryear's rules, institutions, and benign multilateralism, we have perhaps shifted to a world where power, weaponization of economic tools, and even coercion is now the order of international engagement. Africa has probably never been more relevant geopolitically, whether it is through the lens of its abundant commodities or the opportunity to fill the vacuum, increasingly that is afforded by the dialogue of reshoring, friendshoring, and nearshoring. America is exceptional. It's exceptional for its economic heft, at about a quarter of global GDP, for its share of capital markets, global capital markets. Indicatively, American equities account for 62% of global equity. That's astonishing. Of course, the dollar has been a significant underpin to America's wider hegemony. And then, of course, there is America's military prowess. America will this year spend more than $1 trillion on its military complex, typically more than 3 times that of China, and as much as the 9 next largest military spenders combined. Some would say this is not just deterrence. If we look at the last couple of decades and America's active engagement around the world, its widespread bases and alliances, one would argue that perhaps America has a proclivity for engaging militarily. But for all of these elements of exceptionalism, which we don't think is necessarily going to come to conclusion or going to end America's dominance, what America lacks is the upstream supply chain of modern materials for new age goods and perhaps even services. China, at least with respect to rare earth metals, aluminium, to a degree copper, and even lithium, dominates. History with respect to the Industrial Revolution guides us to believe that those nations that were at the forefront of the innovations and technological frontier of that time would dominate global affairs, not just for decades, but for centuries. Perhaps artificial intelligence is today's spinning jenny, and those that control the rare earth metals and the other inputs into the ecosystem to be able to produce the hardware and create spillover to the software will dominate. So activities in Venezuela or Greenland are deliberate. They speak to what America lacks, and it speaks to China's advantage in the current era of technologies like artificial intelligence, immersive reality technologies, and even quantum computing. And China is somewhat prepared to the extent that it's insulated. Over the last couple of years, this trend towards not deglobalization, but trade becoming more regional, trade becoming more local, has also featured in Asian affairs. 30 years ago, less than half of all of Asia's trade was intra-region, intra-Asian trade. More recently, it has risen to around 60%, and we think by the end of this decade, intra-regional trade across Asia will surpass 70%. That speaks to this buffer that China has built, and Asia more broadly. So trade is maturing across Asia. Supply chains are increasingly strengthening across ASEAN and, of course, North and South Asia. We're not suggesting at all, as I did a moment ago, and to confirm, that America's exceptionalism is about to be confronted, or at least it will be confronted to the extent that there is now other parties and more voices in the game, in town. And America will therefore enter this period of geopolitical contention. What was remarkable about last year was that global growth was steady. This references 2025 GDP growth and forecasters' views month on month through the year. It's astonishing if you consider that global growth ended more or less in line with January, February estimates. In other words, the global economy hardly stuttered, despite all this geopolitical buffer. And I guess that speaks to a few things. It speaks to the adaptability of the global economy to shocks. It also speaks to this tilt to lower inflation, which unleashed an almost synchronized global monetary policy easing, creating easier financial conditions. Emerging markets performed handsomely, aided by a preference for investment flows flowing towards emerging markets and somewhat of an aversion to developed markets, including the United States. And of course, buoyant commodity markets created a virtuous cycle in many emerging economies, and especially on the continent, helping to engender steady, if unspectacular, but steady economic growth. And perhaps that sets the scene for 2026. Steady, if unspectacular, but welcome steady growth. Buoyant commodity markets, which will be a fillip for especially the continent. and generally easy monetary policy. But that shouldn't mask the fact that geopolitics has materially shifted, and as Mark Carney suggested, a rupture. And so this panel will engage on how we think that rupture is going to unfold, and perhaps with the leitmotif that I suggested a moment ago, Africa has never been more geopolitically relevant in at least the last 30 years. Thank you. Gugu?
Gulam. Gulam and I will not be engaging in conversation in isolation. We'd also like to welcome up on stage two of our panelists joining us, Dr. Michael Power, Managing Director of Kazi Consulting, and Ms. Yvonne Mango, Africa Research Economist at Bloomberg. Please give them a warm round of applause as they make their way up on stage to join us for a seat. Yvonne, feel free to have a seat to my left-hand side, please. Mr. Power, glad to have you. You can have a seat in the middle. Thank you kindly. This is probably the one panel discussion that I believe is very exciting for everyone, because all of these thoughts, the headlines, the themes, the discussions, the threats, the concern, I'm sure have left us all feeling exasperated in the last 2 years, right? Right? Or maybe I'm wrong. But that's the point. There's so many thoughts and so many themes to actually pull at in terms of understanding where we are within this particular cycle of not only geopolitics and macroeconomics. Gulam, you've highlighted so many critical themes, and I think there are quite a few that stand out. Your last point, that Africa has never been this relevant. I believe, Mr. Power and Yvonne, this provides you both with an opportunity perhaps just to reflect your observations and your thoughts on some of the highlights and insight that Gulam has shared with us this morning. Yvonne, your thoughts, I guess, as an economist who focuses on sub-Saharan Africa, you're quite optimistic that this is good news for the region.
It is encouraging, though of course we have to be strategic. And thanks to Standard Bank for inviting me to this forum. So firstly, as Gulam mentioned, we've seen a shift in terms of moving from this US-led globalization into contested multipolarity that we're seeing, whereby we now have multiple powers that are now actively coexisting, and likes of the EU, India, China, as well as the middle powers that Gulam mentioned, including the likes of Turkey, Brazil, but having to now operate under different rules of engagement and influence, and all that's being actively disputed. And we're seeing this play out in economics, and in geopolitics, in trade, and in security. So that's what we're seeing at this point in time. Of course, that has implications for Africa, which we'll continue to delve into.
Definitely. We'll definitely pick up on some of those themes, especially just in terms of which regions, markets, countries are getting it right, but also, most importantly, the policies that we need to unlock, the capital that also needs to be invested. Mr. Power, I'm quite keen to get your thoughts and perspective as well, because quite a bit was shared, but naturally a turn in the tide. But your reflections on the presentation we had from Gulam, and maybe this is an opportunity for you as well to pry a little deeper to some of the thoughts he shared.
Thank you very much, and thank you, Standard Bank, for inviting me. As Gulam always knows, I don't ever follow the crowd. I tend to look at things somewhat differently. One of the big phrases that we've heard in the last year is deglobalization, and I do think that the world is not so much deglobalizing as reorienting. And do remember that for 20 of the last 22 centuries, according to the great Angus Madison, Asia has been the center of economic gravity in the world, and I think the status quo ante is being restored, and so the moves going on at the moment are secular. I think that when we think about this reorientation, we need to move away from what is central to this particular conference, which is capital, and start focusing more on trade. The US-centered world is obviously driven by capital, as was shown in the list of questions we've just been asked. There wasn't a single one that mentioned anything to do with China. But China controls the world of trade, and I think that is something that is particularly central to Africa's future, because I think, with the exception of Eswatini, every country in Africa has as its #1 trade partner on both fronts, China. So I think it is an important consideration. The best prism to start viewing the changes that are taking place at the moment is not through the capital account, it's through the current account, where the trade is captured. Now, this is not familiar to most of the people sitting in this room who probably live and work in capital markets, but it is something that you need to pay far more attention to moving forward. This means stop being hypnotized by the dollar. I would have loved to have seen the question today, not on what the dollar is going to do against the euro, but what it's doing against the renminbi, which this year and over the last 12 months has been far more significant than the moves that it's had against the euro. So this is all part of the change in the way that we need to start looking at the world. I would strongly encourage central banks in Africa to start denominating their foreign exchange reserves in two currencies. Tell us from month to month what happens to the dollar amount and what happens to the renminbi amount, because that way we can start to understand the world that we're moving into. We're moving out of a world that is centered on US capital. And remember, the US wants capital from the world. It doesn't give capital to the world. It runs a current account deficit of $800 billion, which means it must attract $800 billion into the United States in order to balance its external account. It doesn't is not a net contributor to the world of capital. If you want to look at who a net contributor of the world of capital is, it's going to be China, because China's running a current account surplus of $1.8 billion a year. So it's a mind shift that is going to be very uncomfortable for us, but particularly in Africa, where we're on the front line of the battle that's taking place for influence between the US and China. Be on guard. And I thought I'd just
Michael,
give you one anecdote.
Sure.
The end of last year, Kenya switched 70% of its railway debt from dollar denominated to renminbi denominated. 1st of January this year saw its credit upgrade. Why? It saved $200 million on its external payments by switching to China.
Valid points that you've mentioned there, Michael, and thank you for giving us some perspective. This is where I'm hoping we can roll up our sleeves and deep dive into the conversation with your assistance as well as audience members who have key questions and themes that you'd also like to engage on. So please do be mindful that we will be taking your questions both in the room and online and addressing them to you. I think we're all sitting here and we're thinking, my goodness, several themes that we have to clutch on. First things first, perhaps let's focus on the trade dynamic that has been highlighted. And this, I guess, is addressed to all of you as panelists, but perhaps starting with yourself, Michael, given the opportunity that you alluded to, AGOA has been extended for the next, 12 months, till the end of the year at least. And as you've mentioned, the new trade partnership between China as well as 53 countries on the African continent. Many have said that this offers great opportunities, as you've highlighted, but there almost seems to be this balance we need to strike in the structural shift of improving our trade, moving to a surplus, but at the same time mobilizing and capacitating the industrialization of markets on the African continent. Help us understand how we strike for that dynamic. And I say this because many have raised a concern that our areas of weakness shouldn't shift from trading too much with one region over another region, but maintaining optimism and growth across sub-Saharan Africa.
Well, aside from recognizing the shift that has taken place, and not enough of us do, I think we have to understand that there is a huge challenge facing Africa at the moment as a result of the rise of automation in the global economy, and automation which is again being led by China. Now, 5 years ago, if you'd heard me at this conference, I would have been arguing for the growth of low-end manufacturing in Africa so that it could essentially move up the value-added chain, start exporting, as Lesotho has been doing, textiles to the world. It's becoming more difficult to do now. Automation is not helping. The shift, and you can see it even within the Southeast Asian region, of manufacturing from China to the rest of Southeast Asia has been marginal. Yes, they may gain on lower labor costs, but they haven't been gaining on lower production costs, overall production costs, including labor. That is still, generally speaking, happening at the lowest cost in China. And the Americans have started to realize this too.
100%, and that's a major concern as well, just in terms of how best it is that we tap into that opportunity. Gulam, I'm keen to have your thoughts come through in this conversation because it interlinks then to the theme regarding infrastructure. So perhaps both yourself, Yvonne, and Gulam, I'm shifting the conversation to focus on that critical investment that we need to make in infrastructure. And perhaps I highlight this because it also came up just last night in the cocktail engagement with members of the creative industry who highlighted access to digital infrastructure does make us competitive in terms of the creative industry overall on the continent. To help us unlock the interlink that does need to take place even further here regarding our competitiveness in certain sectors and how that speaks directly to infrastructure investment, but the innovative ways of funding that we need to implement.
Kuguletu, so a few things, and if I may just preface that also with alignment with Michael, even though his suggestion was maybe I would be contradictory. So a few things. Trade is about 50% of Africa's GDP. So it's been the quiet engine and has been engendering quicker growth and been a source of prosperity and per capita incomes. 7 of the world's 10 fastest growing trade corridors now exclude the US, and they involve Africa, the Middle East, and the Far East. And so there is Africa's opportunity for insertion. Africa is potentially at great peril to the extent that it has been unable to establish heavy manufacturing. And the language is routinely that Africa must insert itself into global value chains, from shifting rocks to shifting products, from being able to, on the back of nearshoring, friendshoring, to become a trusted partner in this geopolitically fraught world. And the difficulty is that China, and sometimes China plus one nations, are establishing themselves dominantly in new age production. And we know that to be perhaps most prominent, for example, in BEV vehicles, battery electric vehicles, and other new energy technology products. And Africa is going to be left behind in this third chapter of China's manufacturing ascendancy. Quickly, the first chapter was low quality but cheap goods. The second chapter was high quality and still cheap goods. And now the third chapter is new age products. So if Africa is going to establish itself as an attraction for the next factory, the next smelting and processing plant, the next mine, a few things must happen. The regulatory, the policy environment must be more inviting.
Yep.
Reforms with regard to foreign exchange so that liquidity is ample and individuals and foreign investors can invest not just in portfolio arena, but also in the real economy. Power has been decapitating for a length of time. Across Africa, the extent of power availability is the equivalent of some single country Western nations. It is so scarce, and power, of course, is oxygen. But that has been improving and improving measurably, and especially with regard to more modern solar-oriented options. But the reform agenda with regard to enhancing the investment climate on the continent, the capacity to enhance predictability, even if it isn't perfect, needs to improve. But even though I sound a little bit hesitant and daunted, in 2022 and 2023, the Middle East invested about $113 billion across Africa in ports, in energy, in infrastructure, in retail, hospitality. And that was 3 times as much as China. So the Middle East is, while a middle kingdom, it's a superpower with respect to capital. And to conclude, with regard to the infrastructure opportunity, at Standard Bank we talk a little bit lyrically about this arc of prosperity, Africa, the Middle East, and the Far East, creating this arc of 2/3 of humanity, new sources of capital, new trade corridors, and perhaps commercial trust against the backdrop of fraught transatlantic ties and a muscle posture by the United States.
Got you. Many themes that have been mentioned there, but really do provide us with a critical understanding of not only some of the threats, the opportunities, the concerns, but most importantly, how we get this capital flowing. In a moment, I do want to come to you as the floor to ask some of your questions to the panel, but I think there's so much that has been highlighted, that it's not just about the East versus the West, but of course opportunities with the Middle East. Of course, finding that there's an increase in terms of capital that is coming towards the continent. But Yvonne, this is where you come in to help us elaborate whether this financing is being costed correctly. And I ask this because we're well aware that in certain regions there's been a heightened level of investment, at times reforms that have been implemented as well to make some regions and countries more competitive. But what are we seeing in terms of the capital inflows, the pricing, and is there a shift in terms of how that view or risk is being analyzed in sub-Saharan Africa?
So countries that will still enjoy significant capital inflows are those that have established macroeconomic stability, where we see credible and policy discipline.
Can I push you on that one and give us a region, give us a country? As we heard, there's a lot of optimism and some excitement around where that is.
I think that it's a few factors. So where we're seeing reform stories, I think it was mentioned when we had the poll earlier that West Africa will outperform. And I think that's a reward to the significant reforms we've seen in the region. In Ghana, it's through debt restructuring. In the case of Nigeria, it's deregulation of the foreign exchange and the petroleum sector, and that we're beginning to see the economy now pick up in terms of its performance and the currency appreciate on the back of it, as well as inflation come down, allowing for borrowing costs to decline. So in West Africa's case, you are seeing the case of reform story. You mentioned earlier gold and what that's done for that economy in terms of the currency, as well as bringing down inflation to as low as the single digits. We had it over 50% just over 3 years ago. So certainly a reform story represents or presents upside for investors, and that's what they want to see. High growth and diversified growth. I think that's what East Africa tends to offer the continent. It's growing at close to 6%, significantly higher than 4% for the sub-Saharan Africa region. And I think you continue to see investment going to logistics in that area, the tech sector, which remains pretty attractive, export-based infrastructure. So East Africa continue to attract investment. So my first point is that macro credibility is where you'll see capital inflows go into. In the new global order, strategic assets are important. As we've spoken to critical minerals earlier, countries such as the Democratic Republic of Congo are certainly benefiting with large reserves of copper and cobalt and the energy transition metals, countries such as Zambia in that regard. In addition, when I speak of strategic assets, not just speaking to commodities, but also logistics, ports. We've seen a lot of interest from the Gulf in our ports, in particular in East Africa, and I think that also supports that. But also increasingly now in the world that we're in, digital capacity and institutional capacity, digitization is seen now as a multiplier for traditional fundamentals. So, for instance, in the case of Africa, if you have digitized governments, that improves your revenue, improves the fiscal resilience of those particular countries. It helps in terms of expanding your export potential in terms of tech as well. So I think those particular factors are where you see capital being drawn. So macro stability will determine whether you get inflows, capital inflows. However, if you see digital capacity improving in particular countries, that will determine how much you will get and the type of capital that will flow in that particular country.
Important points that you highlight, and I do want us to come back to the theme around technology and digitally enabled in just a moment. I do want to take the liberty of just double-checking with the floor if there are any questions. We're more than happy to hear your thoughts. To the governors of central banks, I hope you've been paying attention to some of the themes that have been shared, and maybe this is your opportunity as well to share your perspective on some of the themes that have been highlighted. By show of hands, any questions from the audience? Please feel free to raise your hand up high. Your hand has been noted, sir. I will kindly request that you keep it up a little higher. It's just easier for my colleague to identify you. We're happy to take 2 more questions if there are any available in the room. Thank you so much, sir. Please go ahead and introduce yourself.
Thank you. My name is Bankole. I'm with the IFC. It's more for Dr. Power. So I can relate with African countries that import a lot from China, moving significant portions of their reserves to renminbi. but I would like to hear your thoughts on how they manage the fact that liquidity is still quite low in the currency, and there are capital controls, which makes it more difficult to use it as a reserve currency.
China is not in a hurry to become de facto one of the world's reserve currencies, though Xi Jinping last month did say that it was a medium-term objective of China to be one of the world's reserve currencies. And yes, to do that, they will probably have to find ways of opening their capital account to a greater degree. That doesn't mean that they go full no exchange controls day one, but they can do, and are already doing, small adoptions. We are beginning to see, for instance, through the digital yuan, the opening up of trade to currencies other than the dollar. And the yuan is putting itself forward as a player. It's becoming a very significant player in the oil market where the US is not involved on one or other side of the trade. So I do think that this will be a gradual process. I have to say that I have done a lot of work on the pluses and minuses of being a digital currency, and a reserve currency, and I don't think they're all pluses. I think you have to be very careful before you embrace that one, and I think China is being very careful before it rushes headlong into the idea of saying we want to be the world's #1 reserve currency. They're not going down that path. Yes, they have a closed capital account, but that doesn't stop money leaving China to invest in the rest of the world. I mean, a nice example, and it somewhat relates to some of the other discussions that we've been having already, is that Chery has agreed to buy the Nissan plant just outside of Pretoria to assemble cars here in South Africa. BYD is strongly rumored to be looking at buying one of the assembly plants around Port Elizabeth. I don't know which one. Some people probably have a better knowledge than me. Both of which required permission for those two companies to take money out of China to invest in Africa. So it's not as closed as many people might think, but it's not open in the same way as the US. But let me just remind you, the US, the flow of capital is not from the US to the rest of the world, it's from the rest of the world to the US. In fact, last year, 60% of the world's mobile international capital flows went to the United States, a country with 4.2% of the world's population. 60% of the world's mobile capital net flows went to the United States. How do we know that? Because the US had 60% of the world's current account deficits. It's an equation that has to match. So when we think of the US dollar and we think, oh, the US, where's that US money coming to Africa? It's not on a net basis. It's going from Africa to the United States. From China, it's not flowing hugely. But if you look particularly in terms of their investment into infrastructure in Africa, and it may not be showing up on, for instance, things like stock exchanges or bond markets, but for instance, the Tazara Railway has now being rehabilitated, had originally being built by China under Mao Zedong. It is now being rehabilitated by China. And we're seeing a lot of the infrastructure, particularly the east coast of Africa, being essentially rehabilitated or in some cases built anew, funded by China. And so that is capital that has to be leaving China in order to achieve that. I honestly don't see very much of that happening out of the United States.
Got you. Happy to take two more questions from the floor if there are any right now as we build up on some of the themes. Any questions? A little higher? There we go. Fantastic. Please go ahead with your question, sir.
Morning, everyone. Louis from Momentum Group. I would like to hear your views on what you believe Africa's value proposition is in the context of AI, and how can we strategically position ourselves to get the best for ourselves in this geopolitical world? Thanks.
Great question. Is it directed to anyone in specific? Because I can tell, Mr. Power, this is one that you look keen and eager to go for. But Gulam, feel free to add your
If you
thoughts.
want to add, and I'll add on something.
You want to lead?
I don't mind.
Okay. By definition, the continent is prone to leapfrogging. The continent is, for example, bricks and mortar shy. And so it cannot develop in the traditional models of, say, in the financial services industry that delivered financial services through infrastructure that is more analog instead of digital. In the same way that we've leapt from 30 years ago, near zero mobile telephony to more than 900 million connections. And still with the extent of fixed line telephony that existed in 1990 being about that level now. So it lent itself to the adoption of mobile telephony simply because, as I'm suggesting, it was going to generate diffusion at a lower cost and bypass the inability to deliver banking service in a more traditional mode. You've got substantial demography. You've got a one of the most significant network industries that has established on the continent is telecommunications. And that means the capacity for, as I said, diffusion, wide and deep, means that the veins of the system has already been well established. Admittedly, the quantity of investment that is flowing into investment in AI type of activities and infrastructure, commercial infrastructure and commercial activities is still shallow. It's about less than $10 billion currently, and it tends to be sprinkled more across the eastern corridor than elsewhere. However, given the proximity of the continent in terms of time zones, it's, as I suggested earlier, the capacity for establishing commercial trust across the West and the Eastern markets means that over the ensuing years, the ability to establish itself as a bed for artificial intelligence development and for providing safe services to the rest of the world, as well as the raw need on the continent to use artificial intelligence as a developmental mode is ripe. And just to conclude, mobile money transfer was invented on the continent. One, out of necessity, and quite simply the second, because of the capacity of the continent to pursue that with vigor, meaning the skill sets are abundant. So I think we're likely to be surprised on the upside in the ensuing years with these technologies finding commercial relevance in an endogenous and an idiosyncratic way, and as well as the continent being an exporter of artificial intelligence services, modern technology services, frontier services to other parts of the world that are going to look for that friend-shoring, safe-shoring of international supply chains as they shift towards predictability and resilience rather than efficiency. Michael?
I think what we need to understand is that there are two philosophies towards AI in the world at the moment. One is the US philosophy, which is that you essentially have to pay $20 a month to have a subscription with Google. And the other is the Chinese philosophy, which essentially means that you access AI for free. One is called closed weight, the other is called open weight. The interesting thing about it is that added to the open weight being free, it is also much more connected to what is called the edge in AI. And the edge is essentially my mobile phone here and the other 900 million mobile phones that probably are in Africa at the moment. The Pricewaterhouse did a study just before the new year on adoption of AI all over the world. And unquestionably, they saw that Chinese AI was being adopted far more quickly, not just in Africa, Latin America, Middle East, Eurasia, Southeast Asia, essentially everywhere but Europe, Japan, Korea, Australia, New Zealand, United States and Canada, that the open weight model was winning hands down. Now, the fact that it is free is an incredibly powerful impetus to its adoption. And I cannot see the US model of monthly subscriptions catching on, particularly in Africa. I think that there is a battle royal going on between the so-called large language models of Gemini and Grok on the one hand, and DeepSeek and Quen from China on the other hand, and that will be resolved in the next couple of weeks. And I think we're going to see some big changes coming. And I think open weight will win.
What I'm keen to build up on, especially given the theme of AI and technology, and as you've highlighted, there's some aspects that we need to be mindful of that play a critical role in terms of the infrastructure, the user experience, but one can't separate the theme of AI with energy. Energy to the critical minerals, those critical minerals on the African continent. And that even speaking to the theme of sustainability and what that looks like going forward. Are these conflicting views that might continue to perhaps then raise challenges around our focus and our competitive advantage regarding AI? Michael?
I think that although there have been some, in inverted commas, victories for the United States, perhaps in the DRC, in the critical mineral space, that by and large, China is far more embedded in the critical minerals industry of Africa than is the United States. The problem ultimately comes down to the fact that in China, they can direct companies to pursue their national agenda. In the United States, it's become very difficult for them to identify which companies they're going to push in order for them to be involved in the DRC or wherever in the extraction of coltan, for instance. So I think that we have an interesting, again, it gets back to a difference of philosophies. And I think that, as we're seeing pretty much on the mining side, but also critically on the refining side, the Chinese model is winning hands down at the moment.
Sure. Gulam, go ahead.
Guguletu, so I think everyone in this audience is well aware, for instance, that initially America sought to preclude China's access to NVIDIA's more superior chips. And the combination of algorithmic efficiency, open source engineering, and system optimization has allowed China to close the gap in terms of its more deficient microchips and its capacity to deliver computing outcomes in line with the United States. And hence, you could argue that is why the United States ultimately did not use the preclusion of China's access to NVIDIA chips as a tool, because China, in fact, were able to optimize that Formula One car with a weak engine and be able to keep up with an American Formula One vehicle, or at least close enough. And I think in the manner of African trade ties with China, technology diffusion, technology adoption, 2026 is going to be marked by accelerated, to use that word one more time, diffusion. There was a suggestion from one of our colleagues earlier on that all of this investment that has gone into artificial intelligence may not generate the cash flows.
Yeah.
The other salient figure at Davos was, of course, Satya Nadella, who spoke about that it is a bubble in artificial intelligence if artificial intelligence productivity and usage remains confined to predominantly the tech firms and to rich markets.
Sure.
And maybe not over the next few weeks, as Michael suggested, in terms of who wins, in terms of winner takes all, large language model prowess, but in terms of diffusion, 2026, and African diffusion, I think is going to be the hallmark here in that respect, aided by the China model versus the relatively more closed, priced American model.
Moving dynamics that we do need to be cognizant of in terms of these themes that have been highlighted. I'm aware that we are slightly under pressure for time, but I don't want to ignore another concept that is critical in terms of the conversation we're having here today. Yvonne, as you've highlighted, we need the policy certainty. We need to ensure that we do have viable environments. Whilst trade is also opening up to the continent, we need to ensure that the necessary infrastructure investment to facilitate manufacturing and our competitive advantage therein also needs to be explored. AI and technology has far-reaching ripple effects, but of course can also continue to propel the growth that we've seen. Much of the theme, Yvonne, as I come to you, has been focused on where we're attracting capital from, how various markets and regions are being viewed on the continent, but what do we need to do to continue to deepen our capital markets, liberalize funding and financing, especially from areas such as the pension funds industry? We've got various players who are present here, but how best do we need to approach that from a regional point of view?
So we're in a situation where debt is an issue in several African countries. Half of the countries in sub-Saharan Africa have debt servicing costs of above 20% of their revenue. And at that point, your external debt servicing costs become pretty high, and you start looking inward for resources, which is towards your domestic institutional investors. So what you'd like to see there is modernization of prudential investment rules. Because at this stage, we find that a lot of domestic, or most domestic institutional investors are investing in short-term assets, so basically money markets. And what you'd like to see is modernization, essentially raising of that allocation, so that you see some of those assets going into infrastructure, into project bonds, providing basically some of that long-term funding that's required domestically. But it needs to be done in such a manner that the rules or the regulations put trustees in a position whereby they feel that they can comfortably invest without breaching their fiduciary duties.
100%. Very important themes, and the truth is when it comes to talking all things macroeconomics, we'll never get to all the topics at hand in one panel discussion. Hence, we have conversations throughout the course of the next 2 days. But fundamentally, the themes and the concepts have been put in place for us to understand how, regardless of whether you're influencing policy, you're shaping the monetary policy stance, critical decisions as to where to invest, or in certain sectors that enable and help facilitate growth, is that we all need to be aware of how the global macroeconomic themes do contribute to the fundamental decisions we take within this region. I do want to ask one closing question as your final remarks in the interest of time for this panel discussion. And this one perhaps is one that I think many of us might consider when we think of the spaces that we operate in. If you had to be finance minister of any country on the continent for one day, and you had $1 billion revenue windfall, where would you invest it to ensure that there's resilience in your economy by the year 2030? Yvonne, let's start with you as we make our way down.
I think I'd pay down debt.
Simple. Pay down debt. Michael?
I'm assuming you actually do have access to the sea. Ports. They are the mouths of nations.
Ports. Investing in ports. Gula?
Enhance governance. Enhance the rule of law.
Enhance the rule of law. So to the finance ministers in the room, deputy finance ministers, if you have the ear of any finance minister, I think you've got 3 themes that you can potentially discuss with them during our networking sessions available here today. So please do be active and of course engaging in the various themes that we've discussed. But I hope that this does help you set the tone and the theme for many of the themes that we need to be mindful of as we continue to engage with many of our peers on the continent and from the world over the next 2 days. To Gulam, Michael, and Yvonne, thank you so much for indulging us in your time and your knowledge, shifting gears and, of course, themes that we've discussed here, and, of course, for the questions that have come through to give us some certainty as to what weighs heavy on your minds in ensuring that the continent remains competitive. Ladies and gentlemen, please give my panelists a round of applause as we make our way off stage. To Gulam, Michael, and Yvonne, a big thank you for their contribution. Thank you again. Thank you so much, Michael. Thank you, Gulam. As you can tell, the conversation does continue right off stage, and that's exactly what we want to drive, is that momentum to pick up on the key themes that have been discussed, revealed, and perhaps that have planted a seed for different and more innovative thinking from our panelists. I do want to keep you in the room just for another 5 to 10 minutes, and that's because this is where we really shift gears and deep dive into the key themes that were shared. We asked, which region is growing? Which countries are propelling? And one key unique aspect of AMC is the fact that we offer nations an opportunity to represent themselves, to share their visions, to be direct and clear as to what their outcomes are, and most importantly, how that speaks to areas of alignment with many of us here in the room. So over the next 8 minutes, we're going to hear from a key partner, from an economy that has seen significant growth in terms of its participation in producing crude oil. It is an OPEC member state. It's actively been diversifying its economic interests and largely reaping some benefits from that when it comes to the agricultural environment. However, to give us more perspective around the vision for Angola, we're joined by the Deputy Director for Public Debt Management Unit in the Ministry of Angola, Sir Williamson Rangel, who joins us now to give us some perspective on the opportunities we need to seek, pursue, and the questions that we need to ask. Bem-vindo, sir. Welcome to the front of the stage, and a warm welcome to take a look at the vision for Angola.
I'm audible, right? Good morning, everyone. First, I'd like to thank Standard Bank to present this opportunity to speak about some of the important things going on in Angola. I know the topic is broad, but my intervention is going to focus more on that, what we are doing, what are the outcomes of some of the policies that we have implemented in the past years, what are our main goals for the next coming years, just to show this perspective to everyone, as we believe that there's many ways in which we can collaborate with some of you. So we brought this topic at a time where we have just approved our new our medium-term debt strategy for 2026-2028, and also the annual borrowing plan for this year. So we thought that it was interesting to bring this theme to this event, as it's something that we always get interest from all the stakeholders, be it private organizations, multilateral organizations. So we thought it was best to do this. Just going to mention that some of the documents that we'll be touching here, they are available, and we'll also make sure that you can access this presentation. So because I'm mindful of time, I'll just give a brief of what is going on in Angola in terms of debt management. Our previous strategy, the 2024-2026, had key priorities. I think some of them that we can stress here is about the improving the cost of debt. In the previous strategy, something that we had been pushing is just to be more rigorous whenever we negotiate debt, be it for several purposes. We can talk about debt for treasury support, debt for financing projects, and this allowed us, to increase the maturities on some of the facilities that we have been contracting from several type of borrowers. Maybe the other aspect that I would like to stress here is the fact that we gave up on collateralized debt with commodities. As you may know, in the past, we had these facilities which kind of restrain a lot of liquidity. So in the previous strategy, one of the things that we managed to do is to drop this, as now the collateralized debt that we have is quite minimal. We have with China, we used to have with Brazil and Israel, but one of the points that we wanted to stress here is that we have managed to move away from this. And I'm touching on this because it's a point that is always raised by investors. Also, here you can see how our debt portfolio evolved. As you may see, in 2020, the portion of the debt that we had with China was way bigger, and this included some of the collateralized debt that I was talking about. Now, we have managed to diversify more the sources of funding, and where we stress the United States, we are talking about financing from multilateral organizations. We've also increased the portion of the financing that we get from the markets, and these are some of the key points that we would like to stress. But in managing that, one of the important aspects is obviously the volume, the stock. And we have been on a downtrend volume of debt, as you can see on that graph there, where we went from 69 debt to the GDP ratio of 69% in 2021. Now we are about 50. So we right now are committed to maintaining it at these levels, and so that we can ensure that the debt is sustainable, although there's still many room for improvement, especially in the cost of debt. This is just a continuation of the other slide with more details. Obviously, you'll be able then to access the presentation, and I'll be around over these next 2 days so we can talk about and exchange some ideas about this. Here we have a few objectives that we had in our previous 2024-2026 strategy. We've managed to achieve some of the goals where you see that on the last column within the goal. There's still aspects that we want to improve, and one of them is the percentage of debt maturing in 1 year. Obviously, because of the current situations of the markets, domestic markets as well, international ones, often we are forced to find these short-term solutions to cover some of the liquidity gaps. But one of the key objectives that we have for the next coming years is to, improve and reduce the amount of short-term debt, because this causes a lot of stress for the treasury, and the main goal for us is just to find solutions that will allow us to have more fiscal space to do other things, especially projects related to social needs. Here then we have some of the pillars that we have for the current debt strategy, the one that was approved recently. And one of the main things that we want to stress here is our need, one, to find hedging solutions, especially in an environment where there's a lot of uncertainty. This be it hedging solutions to manage better the interest rate risk, exchange rate risk, as well as the fluctuations in the oil price. So this is something that we want to focus for the next coming years. I would be able to talk more, but again, you will be able to access this presentation later on. These are just some of the evolution of the risk indicators that we have. Like I said, there are certain indicators that are still a concern for us, as it is, for example, the exchange rate risk. Then we have our debt plan. You can see there some of the figures. In terms of the debt stock, I would ask you to focus on the last column, which at the end of the year was around $63 billion. Disbursements for this year, we expect to get about 16 billion, both internally and externally. And then you have also the amortization forecast for this year. I'm mindful of time. Again, this is just a continuation of the previous slide. And then these are just the resources that we are going to get in the domestic market. That includes treasury bills, government bonds, and so on and so forth. Externally, again, we plan, in our annual debt plan, there is the possibility of us going into the market if conditions are, if allow us, of course, and there's also funding from development organizations like the World Bank and so on. well, I'll just have to skip because of the time. I've already received signal, but I would end up with some of what are our priorities. Again, continue to prioritize concessional financing from development organizations. I just wanted to stress, for example, last year we were able to close a framework agreement with the Korean Exim of 1 billion, which will serve to several infrastructure projects. And that's the kind of solution that we'll be looking at. And then there's other many indicators there, but I would end up here, and then we can later have a conversation around these topics. I think that's it from me. Thank you very much.
So much, sir. Appreciate it and the feedback and perspective that you've given us. We will find you. So anyone looking to get a deeper understanding of the debt restructuring and the efforts that you've put in place, which are acknowledged and well received by many participants here in the room. Thank you again. Muito obrigada for your time, sir. Thank you.
Cheers.
Another round of applause, please, ladies and gentlemen, for Vision Angola. And that's part of what we'll have the opportunity to engage on over the course of the next 2 days, is hearing from leaders of policy who are helping to shape frameworks within our different markets and regions to give us some perspective around the solutions that they've put forward to assist us. Well, we're shifting gears, and I am cognizant of time that we are due for a tea break, but that will take place following this fireside chat. This is where we'll have you and afford you an opportunity as well to engage on some of the themes and the topics that will be discussed once we break for the tea break with many of your peers who are present here in the room. A key theme that has been highlighted throughout this morning is the mobilization of capital. And that is what we're going to discuss in making sure that whether through partnership of development finance institutions, commercial banks, and new innovative platforms and funding options that can be brought forward, we want to mobilize capital. To help us unpack this further for a fireside chat that will take place over the next 15 minutes, please warmly welcome to the front of the stage, Head of Global Markets International at Standard Bank Group, who will moderate and lead this conversation, Ms. Elizabeth Mucheme Rintari, who will be in conversation with Dr. Kennedy Mbekiani, the Director General for the Southern Africa Regional Development and Business Delivery Office under the African Development Bank. Please give them both a warm round of applause, Ms. Rintari and Dr. Mbekiani.
Thank you. Can you hear me? Yes. Thank you very much. We've just heard earlier about West Africa's impressive sprint in growth, but as a resident East African, and any other East African will tell you, it's the marathon runners that show their endurance, poise, and resilience. So, Kennedy, I think this is a great segue into you. After your endurance and poise over 25 years in development finance and in trade, it's a pleasure to have you. Per your title, you've always looked at East Africa and Southern Africa. It's happy to welcome you back home from East Africa. This fireside chat, as Gugu mentioned, was to kind of set the scene for the further discussions we'll delve into on mobilizing private capital in the capital markets, as well as in infrastructure space. The timing for this is perfect because at the AU summit last week, your new president unveiled NAFA, the new Africa financial architecture, with a clear message that Africa's problem is not ambition or plans, but their problem is the architecture of risk capital. So in this quick scene setter, we want to talk about how commercial banks and MDBs can work better together in trying to unlock this. So for my first question, in terms of unleashing this Africa capital from sources such as pension funds and sovereign wealth funds, having led both Eastern and Southern Africa, is Africa ready to finance itself? And we heard from Luvuyo earlier that we have the capital, but do we have the structures and the will to actually do it?
Thank you. Thank you. Thank you very much, Standard Bank, for inviting me. I must confess that my bias has always been in sovereign financing. And the last couple of months, we had discussions with colleagues from Standard Bank and other financial institutions. And since that discussion, they became my good friends because I realized that they have a lot of money. The question has always been from the government side. The fiscus is constrained. And because the fiscus is constrained, how do we finance development? How do we bring in private capital without asking the government to provide the guarantee? And that's where we come in. So in those discussions, I realized that there's an appetite, the money is there to invest, but the ecosystem is so fragmented. The pipeline of projects are very poor. And I take responsibility we take responsibility as a development finance institution because for a long time, we've allowed this segmented approach, project by project approach in terms of financing. So what the African Development Bank now is trying to do, actually the meeting at the AU was the second meeting. The first meeting we had was with South African financial institutions. Appreciating the depth of the South African capital market. So in this discussion, we are saying that this project-by-project approach creates problems. Problems in terms of how many can you chase, how many projects can you chase, how much capacity do you have as financial institutions to chase projects. So African Development Bank, with the support of the financial institutions, we're trying to create a platform where we can bring all this segmented ecosystem into one. One is the development finance institutions, the complementarity. What would be our role? We fully understand that the financial institutions, even with the appetite they have, they can only enter the financing cycle at a certain stage. So why don't we come in as the development financial institutions to provide the first loss, to provide the preparation of projects so that we have bankable projects. So that's one aspect within that ecosystem. Then what role can those who provide guarantees play? What role do commercial banks and other investment vehicles play so that we're operating from one platform? And instead of approaching a project by project, we are approaching a portfolio. We are approaching a program. So in that way, then the risks become much more predictable because Africa has this Africa premium, which is a risk that is exaggerated. And that's all the ecosystem is all about. If I may add, the other issue is retuning how government looks at projects and delivery of service. So most of the pipelines from our side are government pipelines. So we'd like to graduate those projects into projects that the private sector can finance. But we have to change the way the government thinks. We need to work together to inform the government and to remind the government that your role is to ensure that the citizens are receiving a service, irrespective of who is providing it. Then you can do the regulatory aspect of it. But traditionally, governments, and we've encouraged it, that the government should own the instrument for delivering the service. It's not about the service, but the role of government is about the service, no matter who produces it. And that's where the partnership comes in. And I think with that partnership, we'll see now productive use of these resources and being able to provide the services to the citizens and to the private sector and so on. So that's how we look at this platform that we're trying to work with other financial institutions.
So you mentioned the risk premium that Africa faces. So, Moody's shows that Africa and the Middle East have the lowest infrastructure default rates, below Western Europe, and a third of actually South America. Yet, we are the home of 20% of the world's population and only attract 2% of global infrastructure investment. What do you think is the cause? And how can we help our governments, to your point, secondly, and capital providers bridge this gap?
Yes, so this new financial architecture that the African Development Bank is leading, that would be based on dialogue with the financial institutions. We are cultivating information from yourselves because you have the experience. Then how do we work together to ensure that even on the risk side, the risk is not as exaggerated as it's being portrayed? One way of looking at it, and that's the reason why we started with South Africa, which is the largest market on the continent, is that if South Africa, which they've been doing, if South Africa is able to invest cross-border, it sends a positive signal to others. But now, as African Development Bank, how do we now address some of the challenges that the institutions, the perceptions, some of them are correct perceptions, some of them are exaggerated. The perception of governance, it's not exaggerated. And we have a responsibility as African Development Bank to work with the governments to ensure that there's predictability on the governance side. Issue of policy reversal. There is a perception that governments will reverse policies. That's why we are coming in and saying we can take the first loss. And that first loss gives upstream, we take the upstream risk, and once we take the upstream risk, then it becomes comfortable for others to enter. We know pension funds, they can only enter at a certain level. We know commercial banks, they'll enter at a certain level. Now, that whole ecosystem with a platform that has transparent governance under the stewardship of the African Development Bank in partnership with all the financial institutions, I think we can create that operating environment that will be attractive to utilizing Africa's capital. As you've heard earlier on, that we are the ones exporting capital to Europe and the US. So we have the capital. So now let's create that environment, and we can create that environment by safeguarding the monies that institutions have, because different institutions have got sources, different sources of money. From the pension funds, they are looking for long tenure, but they are mindful of the mandate given by the pensioners. The commercial banks have short-term lending and so on. They are mindful of the mandate given to them. Now, how do we provide comfort? So that's where we are coming in as African Development Bank through this platform, the financial architecture, to smoothen the entry of institutions in financing.
So if I was to, we have a selection of investors here, from credit insurance to asset managers to institutional. So I'll take the example of Kenya, because I can on this stage. If there was a transmission line that needed to be built, and you're looking at, financial institutions would technically want a sovereign guarantee from the Ministry of Finance of Kenya. How would AfDB in these types of examples look to come in with this new type of structure to still mobilize capital and not maybe require such a guarantee from the government?
Yeah, so it could be...
And why, should investors trust this?
Yeah, it could be a transmission line. It could be provision of water. I'm coming from Johannesburg, and you know what's happening. So transmission line is economically viable, and water is also economically viable. You have a captive consumer. Now, you have the money is available. Why not create a special purpose vehicle with the guarantees? Because also what the African Development Bank is doing is to consolidate all the guarantee institutions so that you have one platform that you can seek a guarantee from. So you have a guarantee where we are taking first loss, but we are also investing in that special purpose vehicle. So the government is, what I was talking about earlier, is retuning the government to say, you don't have to own the transmission line now. The transmission line is a bus taking kids to school, and you pay for the ticket. So you have a transmission line from point A to point B, transmitting from a generation plant to the gate of the city. So this line is funded purely by government and is charging the institution, the distribution institution, which is the government. So instead of the government investing upfront capital, the government signs a concession, and that concession is protected by institutions like ADB and the like. So in that case, why do you need a guarantee from government? You don't need a guarantee from government. Government is one of the investors. They will get returns. After 20, 25 years, you can hand back the asset to the government. And the government, I'm telling you, by that time, they'll tell you that, no, keep on managing it. Because the government role is to provide the service, not to own the instrument of providing the service. So the government is saying, we would like you to provide the service at an affordable rate. It can be with water. So you bring in water, back water, to the gate of the city. And the city council buys back water, concession. They don't need a guarantee from so it doesn't affect their balance sheet. So how the government is going to charge its citizens, it's up to them. If you want to charge zero rate, it's up to you, as long as you are paying the investor for that investment.
So, as all our credit committees are quite obsessed with, is what happens when things go wrong, if they go wrong, in a case of a default, for example. And they'd want to understand why in this structure do we think it may be a bit more solid than a typical structure where they know if you default, I go straight back to the government. This is my IOU, well, your IOU to me. What makes your structure, I guess, what should give us more comfort?
Yeah, we are AAA rated, so that already gives you comfort. From the countries that have defaulted on ADB, maybe 2 or 3 countries. That's a plus, rate that you cannot contest. So having African Development Bank as a partner that is providing that platform should give comfort. It doesn't mean that you should not question or interrogate the bank. But the bank is also getting information from the investors because a number of investors, including Standard Bank, have done cross-border investment way before the governments liberalized. So they also understand the terrain. But what we are trying to do now is instead of chasing project by project, we can have a program, we can have a portfolio. And then based on that portfolio, we can be able to have predictable assessment of risk. So that risk premium then comes down. So that's one part. The other part on the risk, if I may add, is we are talking to governments. Part of it is it's an own goal that we score. When the likes of Moody's and so on, they come into countries to do assessment, what we realize is that government officials have not taken them seriously. So they draft a report, they give the government 48 hours to comment. The government doesn't comment, and they get away with it. So we are working with our country economists and with the governments to say, let's start taking this seriously. Where you need to challenge them, please do, so that this exaggerated risk, we are able to manage it.
And maybe a last question, just following from the panel before on this issue on trade. So when we look at capital and trade, we see that governments separate them, conferences separate them. And Gula mentioned 50% of Africa's GDP is based on trade. And it generates the revenues that ultimately repay the infrastructure development. Leaning on your academic training in trade as a trade economist and your work in it, why are we still mobilizing capital without starting from trade flows? And do you think it's important to combine the two?
Yeah, it is important in the sense that maybe, let me start from my theoretical point of trade, that there are winners and losers in a free trade agreement. So you have to manage the losers. Who are the losers? Who are the winners? The winners are those who have really productive structures. So if you open the border, they will be able to export immediately. So for example, in Southern Africa, South Africa is a winner because that's why you find South African supermarkets in Malawi or Zambia and so on, and you don't find Malawian supermarkets in South Africa. So they are winners and losers. So the question is, how do you deal with the losers so that they develop confidence? So in the long run, it can be win-win. How do we do it? We should be able to fund what we call welfare enhancing free trade agreement. What are the constraints facing the countries like Malawi? I keep mentioning Malawi because I'm from Malawi, so I have to keep mentioning it. We have to provide facilities to build the infrastructure that is constraining Malawi from being productive. So for as long as Malawi is not productive or Mozambique is not productive, they will not see the benefit of free trade, then they will close the borders. So that's where we need to come in. So capital is going to go to Malawi if Malawi has the enabling environment, the infrastructure. So if Malawi doesn't have energy, as much as the cost of labor is low, capital will not go there to invest because they don't want to go to Malawi and start building roads and start building energy plants and so on. That basic infrastructure has to be there. That's why it's important that we build the basic infrastructure to promote production. For as long as the low-income countries are not productive, they will close their borders. Because the trade that we're talking about free trade, but we are talking about free movement of goods, not people. So we've allowed movement of goods, but not people. So a bottle store that closed in Zambia or Malawi because there's ShopRite or Pick and Pay. So what happened to those owners? Those owners then, they come and cross the border because there's no movement of people. They are what we call undocumented. Now, you can have a debate where we say, let's liberalize everything. Capital will flow to where it's very low cost, and labor will move to where it's being demanded. So as long as now we still have a partial opening up of trade agreements, which is only on goods, but we're not opening up on services, we're still going to have this disjoint. Now, if you look at Europe, the Europeans invested a lot of money in the low-income European countries, Ireland, Spain, Portugal, and so on, to build infrastructure. And after they build infrastructure, they saw the benefit of integration. But in our case, we're having a problem to understand that we need to help the low-income countries to move up. Let's take, for example, DR Congo. I was in Congo last year. A bag at the hotel was $50 US. It's an opportunity, 150 million people plus. If Congo would grow at 15% per annum, you can imagine that we cannot even satisfy the appetite of those countries. So capital would follow where the infrastructure is available, where the operating environment is available, but governance, as some colleagues have already said, is critical also for capital to move in. Thank you.
Thank you. And our last question, as last night we were challenged to imagine, because by imagining to do something, then we can create. With these holders of capital in the room, what one change of behavior do you think they could put in place that could materially accelerate capital deployment on the continent? If there was one thing you could mention to them, what would that be?
I think the most important is the perception of risk. I think we can manage that perception, and in order to manage it, we'll rely on you moving in because you've had the experience. And that perception is one that needs to be turned around. If, for example, you ask Standard Bank, you ask ABSA, you have invested on the continent, how many of your assets have been confiscated by the governments? So that's the beginning. And with that, then we can start now the next phase of us also working with the governments so that we improve the operating environment. It's a very frustrating operating environment, I know, because even in my own country, I wrote to some senior official at the Revenue Authority that I'm exporting a vehicle. What do I need to do this? I've never received a response. 6 months later, no response. So we need also as government to be responsive. If it's a yes, make it a yes. If it's a no, it's a no. And be predictable, be transparent, where you can open up a tariff book, and what is in the tariff book you can calculate. And what you're going to be given is the same, the result is the same as what you have calculated. So we have a responsibility as African Development Bank to be able to do that. I hope I'll be invited next year so I can be able to say, okay, from what we discussed, we've been able to achieve 1, 2, 3 on the issue of pricing, that we've been able to work with the governments now. They're able to engage with the credit rating agencies, and we have passed on these messages to the government. We do have governance program in our policy-based lending, where we are asking government in terms of policies that they need to change. And that includes South Africa as well. Increasingly, South Africa has been very active in engaging us, and we're happy with that kind of relationship. So I think it's a risk issue is one that I would encourage them to work on.
Wonderful. I'd echo that very much. Thank you so much for your time and for scene setting for the following panels, which we look forward to. Thank you.
Thank you. Thank you.
Thank you again. Very encouraging insights and a thought-provoking conversation that we've had there. Thank you so much, Elizabeth, as well as Dr. Kennedy, for giving us some insight there. Well, lots to learn, lots to absorb. It's been a busy morning, right? Right? So you know what that tells me? Judging by the slow response, we all need a leg stretch. A coffee break, some refreshments, and of course engaging with some of our colleagues and peers. So ladies and gentlemen, we're giving you 15 minutes. We are aware that there's a slight change to the program slightly. However, we will do our best to keep to time, especially ahead of the lunch break. It's 11:16 right now. Please be back in the room promptly by 11:25. We'd like to start promptly with our next session at 11:30. Feel free to bring your refreshments inside. Network, enjoy. In 15 minutes' time, we'll see you back promptly for the continuation of the program.
Ladies and gentlemen, if we can ask you to please hurry it along, make your way back to your seats. We do need to get going with our program. If we can please be respectful of all our speakers' time and each other's time, please make your way into the venue, find your seats, grab your seats, and let's get going with our next session. Thank you. Ladies and gentlemen, for everyone just outside of the room, please make your way into the venue now. Please take your seats as we are going to resume with the program. Thank you. Ladies and gentlemen, just a reminder, if there are any empty seats next to you, please can we ask you to fill them up from the inside out so that we have empty seats on the outer aisles for all our latecomers. Please fill the aisles, fill the rows from the inside out. Thank you.
right, everybody. Great to see that you all made your way back into the session where we look to build up on the momentum that we've been discussing here this morning. Given the conversations and the networking that I've been witnessing, I think it's quite refreshing to see that we're all keen and eager, right, to engage with many of our peers. How are we feeling, though, so far? Optimistic? Yay? Nay? Some challenges in sight, right? But some key markets that we're looking to hear more of. Correct. We like an engaging audience, so we'll continue to keep that drive and that energy. I do want to emphasize the theme regarding time. As you can imagine, over the next 2 days, we have a number of speakers who will be present with us, and we do want to ensure that we offer them as much time as possible to interact and share their perspectives and views with you, given the conversations at hand. So I do want to whet your appetite and allude you to a conversation that will be happening after lunchtime today, where the 8th Secretary General of the United Nations will be in conversation with the Group CEO of Standard Bank, Mr. Sim Shabalala, to help us unpack some key themes regarding, of course, his history, his knowledge on diplomatic ties. I'm seeing your face look at me and questioning the excitement around this, and the truth is we want to ensure that we keep to time given the schedule, just to ensure that we're able to get through as many conversations as possible throughout the course of the day. So that's one of the highlights we can look forward to, including several panel discussions on unlocking capital, the key drive for infrastructure, and of course several visions for different nations that will be shared. I'll be sure to keep introductions brief to ensure that you know the bios and the profiles of the various speakers. All that information is available on the app. However, to ensure that we do get the conversation moving in line with the program that we have today, we move on to another economy to give us their vision. Robust conversations, has diversified effectively, and as we heard from some of our earlier panelists and peers, they have been implementing some key policies to ensure that they adequately pay off their debt and prioritize growth. To help us understand the further vision that we see, interest rates perhaps still on the cards, we'll find out, but to give us some perspective for vision for Kenya, the Deputy Governor of the Central Bank of Kenya, Dr. Susan Kush, joins us now on the stage to give us more perspective on the Kenya vision over the next 8 minutes. Can we please give her a warm round of applause?
Good morning, ladies and gentlemen. Allow me to ride on the protocols already established and riding on the African culture of storytelling. I'm going to tell the story of the Central Bank of Kenya, anchored on our core mandate, which is first and foremost to maintain price stability, specifically inflation within the target range of 5 plus or minus 2.5%. I'm also going to tell you how we also maintaining financial sector stability, and primarily how we have had to increase our forex reserves because of a strong external sector. I'll start off by highlighting that on the 10th of February, the Monetary Policy Committee of the Central Bank of Kenya reduced the central bank rate by 25 basis points to 8.75%. This was just to continue with the easing cycle, and specifically this was the 10th cut that the CBK had undertaken. And this was informed by the fact that inflation has been below the midpoint of around 4.4%. We've also had our exchange rate stable for the last 2 years, $1 to around Kenya shilling 129, and we the committee noted that there were no risks to inflation in the near term. In the same meeting, the committee also narrowed the interest rate corridor around the central bank rate to plus or minus 50 basis points, and additionally, also the committee adjusted the applicable rate on the discount window to 50 basis point, which is the upper bound of the interest rate corridor. And as I said, that the decisions were because of inflation, which has remained within the midpoint rate, and also noting that the average lending rates in the domestic market continue to decline, though not at the rate at which we would have wanted the same to decline, because we would like at least the lending rates to decline at the same rate in which the policy rate is declining, to enable credit to private sector to also pick up, and hence it will mean that we will be able to see a robust economic growth. Just as you can see from the graph that is showing there, inflation in around October, September 2022 was at the highest of 9.6, but you can see that it's actually within the target range right now. And core inflation is at 2.2%. That was as of January, and non-core inflation at 10.3%. On the economic growth, we have a robust economy which is highly diversified. We've noted resilience in the agriculture sector, and for 2025 we expect our economic growth to grow at 5.0%, while for 2026 we expect the growth to be at 5.5%, and 5.6% in 2027. You will note that that is actually above the sub-Saharan African average and also above the global average. Our economy is supported by one, resilience in the agricultural sector, resilience also in the services sector, and a rebound in the industrial sector. Early last year, our construction sector had actually contracted, but because of the government having started to pay pending bills, specifically in the roads project, the construction sector has rebounded, and we expect that to sustain the same growth levels of about 6.7%, 6.9%. This year and next year. Out of the monetary policy reforms that we have undertaken at the Central Bank of Kenya, the CBR rate and the overnight rate actually track each other very closely, and this has enabled us to have transmission, and I would say efficient transmission of monetary policy, which is good for us, especially at the Central Bank of Kenya. We have also noted that the short-term interest rates and the commercial banks' lending rates have continued to decline, in line with the reductions in the central bank rate. We now, as of January, had the lending rates at 14.8%, while the deposit rates were at 7.0%. And because of that, we have also noted that credit to private sector has continued to grow from actually a contraction of 2.9% in January to currently at January 2025 to currently at 6.4%. And noting that that we were not seeing proper transmission of the policy rate to the lending rate, the Central Bank of Kenya, working with the industry, introduced a new risk-based credit pricing model that enabled us to ensure that all the banks have a common reference rate. Initially, every bank used to have its own lending rate, but what has happened now is we have a common reference rate, and then in addition to that, the common reference rate will either be the CBR rate or the Kesonia rate, that is the Kenya shilling overnight interbank average. Then the specific bank will then, and for every lender, will add a component K, which is made up of either one, the operating expenses, return on shareholders, borrower's credit risk premium, and other relevant costs. The aim of this new risk-based lending model is to enhance transparency and also to increase efficiency in transmission of the monetary policy rate. It is going to come into full effect in March this year, and that's when we'll start seeing how things are going to work out. In wrap-up, and because I've been asked to do so, the current account deficit is projected to be at an average of 2.2, and we have actually noted resilience of our exports, which have grown by 8.6%. For 2025, we've also seen growth in imports and specifically intermediate goods. We've also had increase in tourism numbers as well as diaspora remittance. And because of the strong external sector, we have been able to build our forex reserves to the levels of 12.6 billion currently, which is around 5.5 months of imports cover. And this has actually led to increased and positive investor sentiment. In addition to that, we have introduced the electronic matching system, which also makes our interbank forex transactions to be transacted in a very transparent manner, and it has actually led to one of the factors that has led to stability in the currency. We also introduced the DAO CSD, which has transformed our financial markets as well as enhanced operational efficiency and expansion of digital access, especially to many Kenyans. So this is one other platform that has increased financial inclusion. Lastly, I would like to say that in the Central Bank of Kenya, we have been able to maintain and achieve macroeconomic stability amid multiple challenges, and this is showing up especially when you look at the graph that is up there. Earlier on, you could see that our exchange rate actually had depreciated for a while, but you can see where we are now. We are in a very good space, and we will continue to make sure that we maintain that, and more importantly, that because of the macroeconomic stability and confidence in our economy, that our country was recently upgraded by Moody's, and we have seen a lot of investors who are coming up, a lot of interest in Kenya, and we are also here to ask more investors to come and engage with us so that you can understand us better. Thank you for your time.
positivity all round, and I think one thing is quite clear, whether it's from the Deputy Governor of the Kenyan Central Bank or even our colleagues and counterparts in Lagos, Africa as a whole is open for business. But when we talk about this business, we need capital. But where is this capital coming from? And most importantly, we need to understand the partnerships that we can forge, not only between commercial banks, but players within private capital, private equity, and of course, development finance institutions. Our next panel discussion over the next 35 minutes will give us some insight into how best it is that we are deepening African capital markets and mobilizing private capital. This conversation will be moderated by Ms. Anne Alika, who's the head of Africa Regions for Corporate and Investment Banking at Standard Bank Group. Her panelists include a plethora of various speakers who themselves have years of experience and expertise, not only in private equity, in asset management, but of course in banking and supporting and investing in key and critical infrastructure projects, as well as new assets and innovative tools that have come to the fore. She'll be joined by Mr. Ranulph Coldry, who's a director of Cantor Fitzgerald in Europe, Mr. John Gondolfo, who's the Vice President and Chief Financial Officer at the International Finance Corporation, the IFC, Mr. Grant Howarth, who's the Director and Principal at Metier Private Equity, and Mr. Eric Vandrich, Chief Executive Officer at Oceans Finance Company, all joining us on stage for a productive conversation to help us unpack how best they deepen capital markets. Please warmly welcome Anne Alika to the front of the stage.
Good morning, distinguished guests. Ladies and gentlemen, I'll follow Susan Koech and say all protocols are observed, relying on those who've gone before me. It's fantastic to be here. This truly is the perfect place to what may be an uncomfortable but very necessary conversation. My mission today is simple. It's not to moderate a polite chat, but to have an engaged and lively conversation with my colleagues on stage. Because it is, when we consider the gap between Africa's potential and the global capital flows, it's absolutely critical for us to turn the promise of the African continent into a bankable reality. When we look at the map of Africa today, we're not just looking at geography, but a powerhouse of global opportunity. From East Africa's digital frontier to the massive industrial scale in Nigeria and Ghana, the continent is rewriting the rules of the market. To the north, we see an energy bridge to Europe. In the central, we have the critical minerals that the world starves for everything battery-related and for the green transition. And of course, here in the south, Jola mentioned it earlier, we have the deep financial markets that serve as continent's engine. The reality, however, is that Africa only attracts about 3% of global capital flows. That's an absolute gut punch when we consider that we've been able to define the investment needs that are required. That means it's not just a number on the spreadsheet, however. It means power plants not built, roads not paved, digital grids offline, and economy is growing more slowly. But why is this? The Africa Finance Corporation has looked at this and said the problem isn't money, Luvuyo mentioned it, it's really connectivity. On the continent, we have about $4 trillion worth of capital that's available. Of that 4 trillion, about 1.1 trillion is available in the pension funds and sovereign wealth funds, about 2.5 in commercial banking assets. But where is this going? Do we need to harmonize regulations into an investable landscape? What is it that we need to do to attract external funding to catalyze our own resources? To help us navigate this thorny and interesting minefield, I have my colleagues on the stage. And I will get right to it. So I've got John, Eric, Ranulph, and Grant. Gugu introduced them and their roles a little bit earlier. So getting straight to the question, John, I'm going to start with you. when I find my questions. Just getting straight to the crux of the matter. We know for the continent to truly modernize, the backbone sectors of energy, security, infrastructure ought to evolve from simply being essential to being bankable assets. John, looking at the mobilization of private capital to high-impact sectors such as energy, infrastructure, and agriculture, we know that's in high focus for the IFC. Can you talk us through the initiatives underway, and are we starting to see a meaningful shift of capital flows?
Thank you, Anne, and happy to be here today. Let me start by saying that mobilizing private capital is, at its core, a job strategy for IFC. And these sectors, energy, infrastructure, and food security, really we see them more as platforms that determine whether firms can grow, whether individuals can have access to productive work, and so forth. And so mobilizing capital into these areas is really about creating bankable projects at scale. And so the way we're looking at this at IFC now is that we're thinking about how to support the policy and regulatory reform and the business environment in countries. We heard it in previous panels about the importance of that. We're looking at infrastructure, both physical and human infrastructure, and we're looking at different ways of mobilizing capital and distributing it. And to a large extent, that also involves bringing in money that will de-risk projects. And let me just give you two quick examples. One is an initiative that we have called M300. And M300 is a partnership between IFC and World Bank Group and the African Development Bank to get 300 million people in Africa onto the electricity grid in the coming years. And this is a significant objective. And we are an example of a project that is aligned with Mission 300 is one that we call Zafiri, which is really an investment vehicle that's designed to raise money and channel equity into distributed renewable energy projects. And some of the, under this Zafiri project, IFC is also putting in junior equity that will help to de-risk the other investors in the capital stack. So that helps to encourage more capital to come to the continent. Another is something that we call AgriConnect, which is designed to bring connect finance with farmers and to enable them to finance their businesses and grow their businesses. And that's being done here on the continent as well.
Thanks, John. You've actually said quite a lot there. Just bringing in a few of the others. You talked a little bit about effectively instrument evolution, whether it's the various projects or the de-risking mechanism. But Ranulph or Grant, as localized institutional leaders, what do you think is a sweet spot between collaboration with the DFIs that would support increased participation of private capital into these projects or sectors?
I think the suite of credit enhancements that they already offer are probably are the sweet spot. I think in a lot of places you have the local liquidity, particularly on the credit side in the local bank market or the local institutional market. It's about designing the structures to enable them to participate.
And are there specific project structures where you believe local capital should take the lead without external support?
I think, so for example, we did a deal in Kenya recently where Standard Bank was the main lender. And I think it was interesting the degree to which the local banks were willing to stretch to participate. So they said 5 years is our sweet spot tenor. We said, could you do 8 years? They went back to their ICs to check. They said they needed parent guarantee. We said this is project finance. It's ring-fenced at the project level. They went back to their ICs again. I think the liquidity is there. The willingness to participate is there. There's just the opportunity set needs to be there.
Yeah, and maybe to add to that, I think the DFIs, well, certainly in our world, being kind of a private equity manager, the DFIs on the continent today comprise anywhere between 80 and 85% of the capital provided to independent fund managers like ourselves. I think over the years, commercial capital has fallen out as a result of some of the returns being generated from private equity, and as a result, to a degree, has lost touch with the industry, the managers, what to expect from them, how to mandate them. So I think the DFIs have an incredibly important role to play in almost re-educating some of the industry. And I recall speaking on a panel to some East African institutions last year, and to pick up on some of the regulatory points. It's not a matter of having capital available to deploy, which is a consistent theme. They deploy less than 1% of their total assets under management into private equity fund managers. They just don't know where to start. And they've had their fingers burnt in a handful of situations, and I think have backed off. And I think the likes of the IFC, the likes of BII, an interesting partnership they've announced with the PRC in South Africa, to adopt a more consistent approach to educating the market, I think can do a lot in starting to unlock some of the local capital beyond some of the structures touched on, like Zafiri, which is very interesting, and I think quite groundbreaking in the way the IFC's approaching that.
It's interesting. So, in effect, in what ways do you think, and Erica, I'll ask you, the DFIs could evolve their instruments, transformative ways to evolve their instruments and risk-sharing frameworks? Ranulph spoke about risk-sharing frameworks to not only reassure global institutional investors, but catalyze domestic and cross-border. To some extent, it's a little disturbing to hear that from a private equity perspective, DFIs are now 90% of the capital that's coming to you directly.
Okay, I'll be careful what I say next to John, because I don't want him to smack me. But I used to be able to remember these numbers, but now I'm going to have to read it off my phone. So I just want to give a very quick bit of context, and I know we press for time. So we always talk about this funding gap. So let's quickly put it into numbers and just break it down, and then go to sources and uses. You can see I come from a funds background. So SDG funding gap, depending on who you listen to, $1.3 to $2.1 trillion per year, Africa. Okay. Then infra, 180 to 220 over that, so they were split out. But then if you go into things like structural transformation, which includes transport, so I was very interested to hear the comment about ports this morning, you know, education, energy, technology, innovation, that's 400 billion per year. Okay. SMEs, 331 billion per year. And SMEs, they're quite important because they employ 80% of people and contribute 50% to GDP. So I think we've got to start including those in these calcs. So anyway, fast forward quickly. Those are uses. Sources, 2025, total ODA, total, including multilateral, bilateral, for Africa, 36 billion thereabouts, down about 16% from 2024 for obvious reasons. Then globally it went down about 10%, so disproportionately down in Africa. Then we're going to climate finance goals. 40 billion has been provided for globally by developing nations for climate, globally, 40. Then we've got MDBs, which provided between 40 to 50 billion in funding total across Africa in 2025, 11 of which came from Africa Development Bank. Foreign direct investment, 59 billion, also down year on year, but that was because of some of the big projects in Egypt, so we saw a slight skewing in the market. China provided 61 billion. We heard from Gulam earlier this morning, UAE, 110, but over the last 4 to 5 years, so also emerging as a big player. And then SA banks, and I'm not being paid by our hosts, so take it from where it comes. SA banks, 310 billion across the continent. So, long way around of going, if we're going to look at DFIs, MDBs and everybody else, and where they can best use it is exactly in these type of instruments. It shouldn't necessarily be in the form of cash. I think if you look at enhancements, it's not necessarily as credit enhancements, it's also often just typical enhancements that you would see in any case. Things like insurances, guarantees, some subordinated debt, some subordinated type of equity structure sitting in there, somebody who's willing to take a view on an asset-backed finance structure in there, and then that 30, 40 to 50 billion that were provided by DFIs can be geared up easily 10 to 12 times and make that a lot closer to the $1 trillion gap that we still have. But I think that's probably the best use is those type of instruments. And I'll briefly add one thing, and we see that happening. For the DFIs, it's actually a really nice instrument to use insurances and guarantees because it's a balance sheet issue and not cash out the door. So from a capital preservation perspective for DFIs, brilliant use of funds. And what you will even then have is you will have the instos. Everybody talks about the funding from instos, but you also have insurance products. If you can have insurance and guarantees from the DFIs, you can easily reinsure behind any of the large instos that sit out there and then even scale up the private funding even more. I'll stop because I'll talk for days.
That's probably why Eric's on the panel. Eric, as I listen to you speak, in essence, you're talking about collaboration. So whilst it's key, it remains limited if capital continues to be locked into government wills and bonds. When we do look at the African continent, all this cash that's available, there's significant allocations to government securities by institutional investors. How could we develop better market depth through other asset classes, including equity and the private markets? Okay. Regulatory shifts required? I'll start with you, then Grant, perhaps John.
All right. So if I had the answer, we wouldn't be sitting here today. But I've got a fair few ideas that you can maybe take a look at. Think about, just very briefly, what do instos need to do? So everybody says, you're right, there's this massive amount of cash in there, $1.5 to $4 trillion, Africa-based instos, but they are managing your pension money and your parents' pension money. And when you retire, and when your parents retire, you don't go to those instos and say, how many kilometers of road did you build for me? I'm now retiring. You go to them and say, please may I have my money so that I can now buy food and pay for my grandkids' education. So if you, long way around, I'll keep it short again. If you go to those instos, I think the way to do it is you've got to realize what they need to apply their sources of capital to. They're sitting with regulatory capital, which is the bulk of a lot of their funding, that keeps their credit ratings whole. So they can't use those for slightly more risky type of investments. Then they're sitting with balance sheet funding, shareholder funds, third-party managed capital. They'll have deposit holders or policy holders, and all of those have got a different risk appetite and a different type of thing that they need to invest in. So I think when we start talking to the instos, that's what we've got to go and talk to them about and say to them, what do you need to use your different sources of capital for? Because then we could go to John and his team at IFC and say, create a product in conjunction with us that will allow us to access the treasury funding from the instos as opposed to the smaller allocation that they might have for private equity, for instance. And then for the slightly more riskier ones, there is appetite, but it's a lot smaller check. I can discuss this over some wine at this fine establishment later, if you guys want to as well.
But and maybe picking up from where Eric, I think it's useful to look at it and use specific examples of different sectors.
Yeah.
I think it's quite well publicized and known that digital infrastructure is the one infrastructure sector across the continent that's largely being funded by private capital. I mean, you can debate why, but I think it's because the sector's relatively new. You didn't have the state-owned enterprises controlling that sector, and private capital has led the charge. I mean, we've been invested in various assets across the sector for the last 15, 20 years, started with the support of some of the DFIs, IFC included, both on the equity and debt side, but the industry's matured to the point where the DFIs actually can't compete anymore with the local funders, Standard Bank included, and that industry is now evolving into securitizing individual asset bases, unlocking additional capital, and getting into the institutions in an easy to understand, simple, formulaic way. With the balance of sectors, it's interesting picking up on some of the points Dr. Kennedy mentioned earlier around kind of regulatory structures to increase transparency, consistency, offtake, the guarantees, etc. Where, I mean, South Africa's got one of the best examples on the continent of a success there with the REAP program going back to 2009, 10, 11. And it sounds like the AfDB and others are starting to think about how to roll that out into additional sectors, where I think access is the greater problem rather than capital. How do you access those sectors? How do you access water? How do you access roads at scale? A project-by-project case just doesn't work.
So less a regulatory shift, but more governance, transparency, and consistency. Okay, it's interesting. You've spoken a little bit about the individual's access to the specific projects and products, which takes us quite neatly to talk a little bit about market depth and individuals. When we look at other markets, retail investors are increasingly regarded as key providers of aftermarket equity trading liquidity. And I'm saying this in the context of any private sector investor going into a particular project, into a particular asset, derives comfort from visibility on the exit. So that trend of attracting retail investors is evident across the global markets. It's a critical gap in our capital markets, with the exception of Nigeria, where we see about over 30% of average daily trading volume. Do you think, Eric, that energizing and broadening retail participation could revolutionize domestic African capital markets and the ease of access? How do you think this could be done?
Yes is the short answer.
Okay.
How can it be done? I can use a real live example. We're about to launch one of those products next month with the largest non-banking financial institution on the continent, whose color is also blue, but they're not a bank, and they also come from Cape Town. So you can fill in the dots. And the whole idea is to launch retail products through the insurers that then allows you to go and raise capital for these type of projects. Again, it goes back to what I was saying earlier. Then you've just got to make sure that you design what that product looks like to meet the appetite and the risk appetite of the retail investor. Because particularly in Africa, you've got different types of retail investors. You've got different types of risk appetite within those investors. So you will have companies who might buy some of those products, but you also might have retirees who are looking at those products to take care of what their funding is going to be used for. So I do see a lot of opportunity for it. I think within the banking space, things like ETFs and the like already create that type of opportunity, but I think we can start expanding it even more. And if you start bringing in some of the nice, innovative structures that John or Jonathan or some of the other nice guys in the room can bring, it can become very exciting.
John, Eric sort of brought you into the equity discussion. Where is IFC on its aspiration to increase participation in African equity?
So IFC is, its aspiration is to increase significantly what we're doing in equity. We see equity as being the most patient and catalytic form of capital. And so we're doing what we can to bring more equity in. That said, I think that we want to bring our own equity in ways that will de-risk others. And we're very much, for those of you who know the Global Emerging Markets database that IFC and others have put out into the market and is available through Bloomberg now. On the lending side, our MDB originated assets have lower default rates and higher recoveries than what you would typically see in the market, and that helps to perhaps close some of the perception gap of risk. We would like to do the same thing on the equity side, and so we want to bring equity into more junior positions that will enable others to come in. And maybe just a quick example. We issued a CLO, an emerging market CLO last fall, our inaugural transaction, and we came in the junior equity tranche. And that enabled other investors to come in into the mezzanine and senior tranches, and it crowded in quite a few other investors with a very high mobilization ratio. And I think that's kind of the leverage that we're looking for when we bring in our equity.
Fantastic. Ranulf, on this stage here, effectively you represent global private capital. And one of the earlier panels alluded to this. Even with diversification, the stark reality, a few select countries really attract the lion's share of funding. Why is capital disproportionately directed towards a handful of African markets while bypassing others? Earlier on, there was a lot of discussion around the reality that the risk profile on the continent in actual terms is far lower than the perception. But what do you think we need to do to correct this?
I think, I mean, some markets are obviously going to be more risky than others, to an extent. I don't think that the asymmetry of deployment or the asymmetry of interest is actually is as much of an issue. I think the primary issue is attracting gross capital to the continent, and the secondary issue is sort of how it's distributed throughout the continent. So I mean, like recently you had a huge amount of interest in renewables in South Africa, and that has sort of de-risked the copper belt. So you've got similar interest in Zambia. Likewise, countries with interconnection to the copper belt, like Angola, even the DRC. It's the structures being replicated, sort of novating the credit risk away from the regulator to the corporate sector, the ability to replicate that throughout a larger geography. I think the South African entry point de-risks the wider South African power pool. And so yeah, I mean, what am I trying to say? It's sort of a trickle down or trickle throughout situation.
Yeah, thanks. I'm cognizant that we've only got about 5 minutes left. I just want to throw this out to the audience for any questions. Then I've got one more question for all of you on stage, if there are any. No? Okay, Liz.
Hi, it's a curiosity point. So the IFC had its first, I think, securitization of about $510 million last year of EM loans, I think, which we then repacked into bonds. Is this something that we could do for Africa, or what challenges do you see, or is this in the plans in terms of this mobilizing of the private capital? Thanks.
I think that securitization is certainly something that could be done in Africa. I would say that actually upwards of a third of what we included in that transaction were loans that IFC had originated in Africa, and so that's why I think that it's a securitization is actually quite an efficient structure. If it's because it creates tranches that are rated, so institutional investors are able to participate, maybe not taking the full credit risk, but are able to still channel their capital into it. And entities like IFC and in this case, Mobilist also came in the equity to help to de-risk the rest of the investors. And I think that has good potential on the African continent as well.
Good. Any other? No, I don't see any other hands up. I have one question before I get to the last one. We talked about 1.1 trillion in domestic liquidity. The bulk of it is in South Africa, but we still have a lot of domestic liquidity in places such as Nigeria, Tanzania, Uganda, Angola. Do you see that domestic liquidity in any of your cross-border transactions, or do you typically find it trapped in one single geography? Any of you? Go ahead.
Funny that. I think you are starting to see it going abroad a little bit more. And abroad meaning regionally. When you look at somebody like AfC, for instance, in Nigeria, bulk of the investments are actually not in Nigeria. It's in the region. Going back to the SA-based institutional investors, we're seeing them across the continent as well. But I think maybe the reason why we don't necessarily see it is because of this currency mismatch. So there are very few of the larger instos that sit outside those two regions that have got sufficient liquidity in foreign currency to go and invest in other countries as well. So I think we'll see it at some point, but I think most of them will be very domestically focused. And a lot of them are also tied to the credit rating of the country, so they're very comfortable with that credit rating. So they're very comfortable with the default risks and everything else. And in fact, their credit rating is the same as the government's, so effectively they can take that type of risk. Very hard to do that outside the country for some instos on the continent.
I think you could just, sorry to interrupt. I think it is increasing. Like, so for example, Amson's out of Tanzania recently has done a bunch of acquisitions in Kenya. We did a sell side in Kenya, and we had a lot of West African interest as well. I think people are becoming more and more cross-border in their outlook.
John?
So just to pick up on the currency risk point, and to say that actually we feel that the longer term solution, and hopefully the medium term solution rather than longer term, is the development of local capital markets. And the development of local capital markets requires significant policy and regulatory reform. It's financial architecture. It's everything that goes into the financial ecosystem. And when that develops, the ability to hedge at a cost-effective way currency risks becomes something that facilitates cross-border investments. And it's something that we're focusing on. In fact, we have a huge local currency business. The team has made local currency available in almost 80 different currencies over the last decade. And we think that is both hedging others that want to come into certain markets, but also just helping to develop the local markets is key to that.
It's a shame we've run out of time, because that would have been a great segue into reforms around the development of local capital markets and whether or not unified markets, fewer markets, would actually encourage this. But because we have run out of time, I'll just ask you all one last question. If you could change one policy lever to move the needle, what would it be? And I'll start with Grant.
Good question.
Just one.
I need to think about that a little bit.
I'll
circle back around to me, yeah.
Deregulation of infrastructure monopolies to allow private sector participation.
Deregulation of?
Infrastructure monopolies to allow private sector participation. So like ESCOM deregulated in South Africa, et cetera, et cetera.
Okay.
I'm also going to go for regulation, but I'm going to go on the regulations for pension funds and the increasing the cap for those pension funds to invest outside their countries. I think that can make a big change on the continent.
John?
I was going to say the exact same thing. Pension and insurance regulation. But I also think that putting in place very strong macro-prudential policies that create economic stability is a huge part of attracting capital.
Yeah. Great. Thank you very much. I wish we had had more time. There is actually a question from the audience. One last one.
Hello, thank you. First, I would like to apologize for not asking before. I'm from the media and I come from Angola. My name is Elder Jeremias. I would like to any of the panelists to answer me one question relating to the implementation of Lobito Corridor project. I know Africa needs a lot of investment in infrastructure. And as we know, Lobito Corridor will play an important role in connecting the Atlantic Ocean to the African countries. Which are the possibilities for investing in this project?
Which are the
possibilities? Which are the? Have you got some projects or plans for this project?
Perhaps I can kick that off because I know we have a specific infrastructure panel later on this afternoon, and the moderator is in the room. So Adel, I'm going to bump that one to you for when you have your panel later on this afternoon. It could be tomorrow, I'm not too sure. Do you mind if we address your question at that point? I think it'll be seamless with that particular panel. But great. Thank you very much. I think we are between you and lunch. And so appreciate all your time. Panel, thank you very much for your time. We've kept to pretty good time this morning. Appreciate your candor and the directness with which you answered the questions. Thank you.
Thank you.
Fantastic. Thank you so much to Anne as well as her panelists. Please give them another round of applause as they make their way off stage, ladies and gentlemen. If there's anything that I'm learning, there's so many unique nuances to the positioning of various financiers and how best it is that we're all trying to ensure that we tap into the right opportunities and prioritize them. To the colleague and counterpart, your question, as Anne has mentioned, has been noted, specifically related to infrastructure, and that will come up in one of the later sessions, but perhaps might also be raised and be relevant to the next fireside chat. As we know, there are growing sectors and industries that are ripe and of course contribute significantly to the growth of the continent. In Angola, it's moved very swiftly from initial discoveries of oil to ensuring that they now move to first oil in terms of production. Beyond that, we talk about this world of AI and technology, but where are the data centers? How do we get them on the continent? Well, you need the capital, you need the enabling environment, and as we've heard, you need industry players to play a critical role. In this next fireside chat, we're going to be taking a look at investing in Africa, looking at both the risks versus the returns, and how it is that we build up the momentum in terms of finding the right industries, managing how best it is that we identify the risks from the returns. This conversation will be moderated by a key leader, Chief Executive Officer of the Middle East and North Africa region for Standard Bank Group, Dr. Rasim Zok, and he'll be joined by two leaders within the innovative space, not only in terms of technology, data centers and the likes, but also reflecting on the opportunities we've seen coming out of oil production, especially in markets like Angola. Please warmly welcome Rajit Nanda, the CEO of Data Vault, Vision Invest Board Member 2, and Dr. Martin Desfontaines. He's the Managing Director of Total Energies, Angola. A warm welcome, please, for this next 15-minute fireside conversation that will be robust in terms of sharing feedback.
I'll let you sit here. You go ahead.
Thank you very much, and I don't know if the mic is working well, and thank you to the audience. It looked like it was lunch after the other one, but sorry, we're just going to have 15 minutes, and I think it's going to be very, very interesting. So, Martin Desfontaines, obviously, thank you for accepting to be on the panel. One of the senior representatives of Total Energy and the CEO of Total Energy in Angola. Obviously, Total Energy, one of the largest GMNCs in the world, and one of France's greatest exports, I would say, in terms of prestige and presence. To his left is Rajit Nanda, who is a board member of Vision Invest, and he is also the CEO of Data Vault. Vision Invest is one of the largest investment and operating consortiums out of Saudi Arabia, and is one of the largest in the Middle East, with great interest, great track record already in Africa via Aqua Power, and looking to do much more, in particular on the data centers. So really, gentlemen, thank you very much for being with us. Rajit, if I could, if I could start with you. You're such a large, thank you so much. you're such a large consortium, obviously, out of the Middle East. We have, dealt with your esteemed organization for a couple of decades now. Just a simple question. You are in 14 emerging markets. You have $120 billion of assets as Vision Invest. So zoom in on Africa. Why Africa, and why are you here?
Thank you, Rassam, for Standard Bank to have me over here, and thank you also to my distinguished co-panelist. I'm probably one of the exceptionally few non-Africans here in this esteemed and august group of about 200 people here discussing Africa. But let me give, I represent one of the, well, not one of the largest industrial holding companies from the Middle East, Vision Invest, which has a number of flagship entities. The biggest claim to fame is Aqua Power, which has about $100 billion of assets. It's the largest utility and water listed entity in the whole of Middle East and North Africa. Significant assets also in Africa, in Morocco, in Egypt, in South Africa, and now in Senegal. But let me a little bit explain the Middle East at a macro level, the Kingdom of Saudi Arabia at a micro level, and the connection here with the African continent. If you take a step back and you think through this, there are a number of interesting points of comparison. First and foremost, I would say, is the inherent ambition that sits across both of them. Saudi, for the ones that read about it and for the ones who don't know much about it, is the world's single largest socio-economic transformation that is happening in the world. This is a country with $300 billion of GDP 9 years back, and ever since the leadership came and took control, the Crown Prince and the Prime Minister, and he put at play Vision 2030. Today, the kingdom represents a $1.2 trillion economy. Facts about the country that people don't know: it has the index for the happiest nation for people below the age of 30. And that brings me to the second comparison beyond the ambition, which is the strength of the demography between Africa and the Kingdom of Saudi. In Saudi, 70% of the population is below the age of 35. 60% of the population is below the age of 30. Africa, I wish any place on planet Earth would have the same amount of strength on the demography of Africa. Is unbelievable. And the fact of the matter that most of the economists, including the discussions that we had today, seem to forget is demography is destiny. Your biggest resource for all that you believe and all that you talk about is not your mining and mineral wealth. It is your demography, because that is the future, and that future is connected with the present today. This is a continent of 1.4 billion people that is doubling itself by 2050. It's a continent that today provides 850 million people in the global workforce. By 2035, that's just 10 years from now, it will be providing 1.5 billion people in the global workforce. You have to focus on making the best out of your strength, which is your demography. That should be your first and the most important wealth that you have to work on, and make sure that they are not stolen by others, because that's what the world will do. In 2050, 85% of the workforce will come from Africa. And if you don't retain that talent, if you don't build on that talent, you will lose all the strengths, and you're back to where you were for the last 20, 30, 40 years. The third important comparison that I would put on the table is, and we spoke about it in the first panel discussion of this morning, which is the changing nature of the geopolitics of the world, where we have seen in the past, since the end of the World War II, a US-led development of the world, now having moved to what I called a multipolar world. Both Africa and the Kingdom of Saudi have now realized in this last half a decade the strength that they bring to the changing nature of the center of gravity in this geopolitical order, the new global order, the new multipolar order. And I would say that the last but equally important points of comparison is the continent and the Kingdom of Saudi. Both of them understand the structural gap that exists, and both of them are working towards implementing whatever is required in order to bridge this structural gap. So these are some of the key elements. As a group, we believe in the demographic strength beyond the resources, much, much more beyond the resources and so many other obvious strengths that are always spoken about in the context of the continent. For us, we have been in this continent for the last 12, 13 years. We have put about $15 billion of infrastructure capital at play, and both through Aqua Power and directly through Vision. And we continue to believe, and we have a lot of capital that we would like to put into play in the continent. But for us, it is just not about capital, it's about bringing the right level of capital, and maybe we'll speak about it once.
Sure, thank you very much, Rajit. And that talks a lot to the way, close to home, in our Standard Bank DNA, we've been obviously working on this corridor between the Gulf and Africa, and that intensity is obviously increasing by the day, and Vision Invest is a good example of that. Let me turn to you, Dr. Martin. So obviously Total Energy, is a giant, the GM&C space and the energy space. You've had transformations throughout the life of this company. You've been in Africa for a while, in particular in Angola. Just give us your observations, basically, as a major operating company on the continent, and the stuff that you're doing now that maybe before you did not maybe dare to do in Africa, please.
Thank you for inviting me, and it's an honor for me to be amongst all of you guys. Bankers, merci. You know what I would say, I would try to explain you why do we like Africa, actually, because Africa is, with Middle East, one of our major poles in Total Energy. And we are quite old company, 100 years so far, and our presence in Africa is dating, we are in Africa for 90 years. And we have basically managed to build some trusty relations with our counterparts, and this is extremely important in our domain. And when I mean trust, it's quite important, and it goes in both ways. The host country, they can trust Total Energy in bringing what we can bring to them, which is basically, first of all, expertise, and managing to materialize, to valorize some resources that they have. It started with geological resources, but now we are more and more speaking about wind, solar, and hydro. And it's really, you know, our goal to bring all what we can in order to keep innovating, and that's super important. What also we can bring is you know, finance, of course, and for that I would like to thank Standard Bank, because we have quite a lot of, you know, projects ongoing, big projects, huge projects, like in Mozambique, in Uganda, and where, you know, we managed to get some quite important financing with a lot of banks actually, and that was great. And coming back to the trust, you know, it goes also in the other way, where our host countries, they know what we want, what we ask them, and basically what we ask them is stability, and this is extremely important. So we ask those host countries some kind of fiscal, contractual stability, in order that when we launch a project of $1 billion, the fiscal terms and the contractual framework stay the same. So this is this trusty atmosphere that we managed to build, and that we are, you know, benefiting from in Africa. And at the moment, we have, as you know, we will start this year in Uganda a major project. We have lifted the force majeure situation in Mozambique. So we are resuming our big gas project, LNG plant, 30 million tons in the north of the country. And only on those two projects, you know, Uganda and Mozambique, we managed to bring more than 30 banks, and a bit less than $20 billion of external financing. So this is quite important, and looking forward, you know, we have important project in Namibia with a quite super interesting acreage, and we hope to sanction a project that is called Venus in this year, and then after we'll have another one which is the Mopane that will come probably 2 years after. So it's quite the perspective for us in Africa is huge, and at the moment it's moving also towards new energies. Yeah. Because we have about 1 billion of watt that are under construction at the moment in Africa, and another one which is basically under development. Quite a lot of projects here in South Africa, by the way.
Yeah, thanks. Thank you very much, Martin. And just as an add-on to that question, you've been with the company, you know, in leadership roles for over 3 decades, and you've been dealing in Africa for a good part of your career there. How do you see, you know, you've been in Africa for 90 years, so how do you see the way that senior management, obviously Patrick now, but throughout the decades, how did they look at Africa? Has this changed? It's going in the right direction, obviously, because you're doing more. The risk premium, the African premium, as they call it. How do you see all this?
You know, I have experienced myself different CEOs, and with Chourougs, and after Christophe de Margeries, and Patrick Pouyanné at the moment, and I think that they all, and the company as a whole, it's not only one man, you know, but we are all thinking local, you know, and when you are in Africa, if you want to manage, you really have to become African in a way, you know, and to think. And really to think what you can bring, and I mean I could extend a bit more, but what we can bring is also in terms of local content, you know, and I can take the example of Angola. We have quite a lot of suppliers. 1/3 of our active suppliers are local, and it's really a day-to-day effort in order to bring new local, even small suppliers, but in our supply chain, in order that they grow themselves. And we have launched recently a program in Angola, which is called 100 anos sem empreendedores in Portuguese, which means 100 year, 100 startup, where we are helping 100 young people to create their business, whether it is linked or not to the oil and gas or to the solar. But at least we know we are providing this support.
The ecosystem there. Yeah.
So I would say to be close to your question, I think there is our perimeter of action is changing because we are adding new energies, which is important. But I think the willingness to still make business in a respectful way in Africa is persisting and it's still there.
Thank you. Thank you very much. Going back to you, Rajit, you and I have been doing good stuff together for almost a couple of decades, starting with Aqua, so on and so forth. And your ambitions at the time with Aqua were very clear on the renewable programs in South Africa. Then you expanded, and it's been a nice kind of journey, and now you're adding Data Vault. And I just want maybe to zoom in Data Vault. Data center is very critical to infra here in Africa. Can you give us how you see it, and most importantly, how Data Vault can make a change to it?
Yeah, thank you, Rassam, for this question. So I'm now gonna zoom in a little bit from the holding company Vision Invest to my daytime job, which is Data Vault. I run this company. We've started a couple of years back in this digital infrastructure. And let me very quickly explain a couple of things here. First in the context of Data Vault, and then I'll try to map it in the context of both the Kingdom of Saudi and also the African dream that we have out there. So all of you here, in terms of everything that you do every day, you keep hearing the word a dime a dozen times, the AI stack, AI stack, AI stack. And obviously, if I go and ask all the 200 people sitting here your definition of AI stack, either you will choose not to answer, or each one of you will give a different answer in terms of how you define the AI stack. Allow me to give you a very simple definition of the AI stack, as we call it. It's the Data Vault version of the AI stack, and that's important for people to understand how this whole AI thing is eventually going to unfold itself. And by coincidence, it also very closely maps Jensen Huang's definition of the AI stack. I'll not get into the discussion of who came out with it first, obviously he, because he's... But the AI stack, you break it up into 5 simple layers. At the bottom of the layer is what I call the energy infrastructure. Just above the energy infrastructure is what I call the DC infrastructure, the data center infrastructure, which is what has been in existence for the last 20 years. These are the buildings in which you have basically the compute data stored and so on and so forth. They have cooling solutions, they have energy coming in because these are very energy intensive. You need the cooling in order to get the chips always within a certain temperature. They have to be cooled all the time and so on and so forth. The third layer of the stack is what I call the compute infrastructure. Okay, so we just went through energy infrastructure, the DC infrastructure, and the third one is the compute infrastructure. What's the compute infrastructure? That's essentially basically the hardware and the layer of software which virtualizes the hardware. Okay, and what is the hardware? It's basically what you hear all the time, the GPUs. Earlier it used to be the CPUs and stuff like that. And of course the network fabric. The fourth layer of the AI stack is what we call the foundational models. And foundational models are nothing but the Anthropics of the world, the OpenAIs of the world, the Mistrals of the world, and so on and so forth. The ones that are doing the large language model training. And on top of it, the last one of that AI stack is basically the applications. The applications that pretty much work using these large language models and make the day-to-day use, whether it's the industrial use or the consumer use or the enterprise use possible. So that's your full AI stack out there. At Data Vault, what we are doing is we are only focused on the first 3 layers of that AI stack, which we call as the infrastructure part. Not everything is the infrastructure, okay? The 4th and the 5th one are primarily software driven. And we focus only on the infrastructure part, which is the energy part, which is the data center critical infrastructure, and then, of course, the compute infrastructure. We try to, across this whole value chain, work towards delivering what we call the transition of the world from the concept of LCOE to LCC. What does LCOE means? That was the whole discussion for the last decade in the context of energy transition. LCOE is the lowest cost of energy or the lowest cost of electricity. And where we are transitioning now is LCC, the lowest cost of compute. And that's going to be the single biggest enabler in terms of making sure that all of this AI stack eventually gives the value for money, and so on and so forth.
I just want to check that we have, how are we with time? Are you asking us to finish? Okay, all right.
Points that we can walk away with in terms of balancing the risk and the reward.
Okay. I'll just
kept to 30 seconds as a maximum.
Yeah, fast forward it a minute or two quickly.
Thanks.
And so the whole concept for us is right now, the world has two centers of gravities when it comes to AI. And one of them is the US, and the second one is China. Okay. And there is potentially room for a third center of gravity, but that's not coming out very clearly. There is India running after it. There is the Kingdom of Saudi, which is positioning itself for it. There is the United Arab Emirates on the back, and these are the Middle Eastern countries are doing it on the back of the connectivity they have with the rest of the world through the subsea lines, with the availability of energy, which is the biggest enabler, and so on and so forth.
Ranjit, you're going to have to pardon me, together with Dr. Zok as well as Martin.
The whole idea is
that
to
was your
use,
concluding
I'll use 30 seconds to wrap it up and just say that we are using the kingdom in order to put all of these data centers, which we call as the AI factories, and use the power of connectivity to quickly bring AI to the continent of Africa.
Thank you.
That's the vision.
Thank you, Rajit. We look forward to it. Thanks. I see the same passion as ever. Martin, just concluding.
No, thank you for inviting me. And just to say that, you know, companies like ours, where we are global, but we have to know how to be local as well, which is very important in order to keep this trusty relation with the country. And I will just finish by saying, you know, the security of access to energy is extremely important for all the countries, and the countries, I think, should really look at new energies in terms of energy mix, and not only with renewable or not only with fossil, but really to make. And this is a good business case here in South Africa.
Thank you very much, Martin and Rajit. Thank you very much for your time today.
Thank you very much. Thank you very much to Dr. Zok as well, giving us some insight into this panel. And I can imagine this makes for very robust conversations in the boardroom when the deals are being concluded. Please give our panelists another round of applause as they make their way off the stage. Merci. Thank you. Much appreciated. We appreciate your camaraderie as well as your participation. As you can imagine, there's a lot for us to get through, so doing our best to make sure that we give you as much insight as possible into the themes that we will be discussing. Lunch is 8 minutes away. Just 8 minutes. I know we will have an opportunity to stretch our legs and get some feedback, but before we do break for lunch, I'd like to welcome to the front of the stage to give us a vision into Botswana, an economy that we know has often been challenged by some of the recent developments that are taking place within the mineral space, specifically related to diamonds. Please do welcome the Deputy Governor of the Bank of Botswana, Dr. Luvuyo Masinda, who joins us on stage to give us some insight into the vision for Botswana. This is a presentation that will take 8 minutes. Deputy Governor, it's you between us and lunch. I think you can already tell that many of your colleagues and counterparts are being truly participatory in engaging with the conversation and the feedback, but give us your items, vision, and of course, keeping to the time. But there's no rush. Share your message. And if there is an opportunity, we want to have an open engagement as well after lunch. But please, as we said this morning, we're building up the energy. Yes, we know it's been a long day and a lot of information to take, but we warmly, warmly welcome our speakers to the front of the stage. Please, a warm round of applause as well for the Deputy Governor of the Bank of Botswana.
Yes, no, thank you very much, Gugu. You know, good afternoon, and let me observe protocol, right on the protocols already observed. You know, until Gugu here mentioned the name, I've heard several countries' names mentioned across Africa, and nobody mentioned Botswana. One of the reasons is this, and the governor of the South African Reserve Bank reminded me the other day that you now want to go into the market to borrow. You are telling everybody that you've got a good credit rating, but they're asking, who are you? We don't know in these debt markets. Yeah, but anyway, I'll quickly just provide an indication of how the recent developments, growth profile for Botswana, the fiscal challenges, positively the credible institutions and macroeconomic policy frameworks, and the related recalibrations, the economic transformation initiatives provides opportunities for the financial capital markets and investments in Botswana. The growth profile for Botswana, without going to the numbers, is such that we have recently experienced subdued growth. In the past 2 years, a contraction of GDP, essentially because of the weak performance of the mining sector, the diamond sector in particular, while the other non-mining sectors held up. But even there, the profile is such that it is mostly the retail side that is doing well. The core of the economy, that is agriculture and manufacturing, continue to have weak performance. An indication that we have demand in the country, but that demand is mostly met by imports. That is, there's no agricultural production is weak, and related to that, minimal secondary processing. As well, the manufacturing sector is weak. Therefore, that profiles against us the opportunities in those processing industries. And as I indicated, the import intensity is reflected in the performance of the balance of payments and the decline in the foreign exchange reserves, meaning that because we have weak export earnings, whereas we continue to import substantially, therefore we have had a challenge with respect to a decline in the foreign exchange reserves. I'm going to say a bit about policies, monetary policy, exchange rate policy, without going to the details. I think the key message here is that with respect to both, we emphasize transparency so that it becomes predictable and therefore to inform market expectations. For example, our monetary policy framework is forward-looking. Any changes, for example, to the policy rate are premised on what we see in terms of the outlook for inflation going forward. And we currently have an accommodative monetary policy in order to support economic growth. Regarding the exchange rate policy, it's a bit complex, but again, it's the emphasis on transparency and predictability. Our currency, the Pula, is fixed to the South African rand at 50% and the SDR currencies at 50%. It is a crawling peg arrangement whereby we adjust the crawl rate based on the inflation differential such that we maintain international competitiveness of our domestic industries. The basket in terms of the composition of the rand and the SDR currencies can be changed, as well as the rate of crawl as indicated. But the important thing, as I said, is we pre-announce these changes so that it becomes predictable and the market can, based on the cross rates of the components, currencies, can make an estimate of where the pool exchange rate is likely to be going forward. The fiscal situation, currently substantial deficits. We had for a long time a statutory limit of debt to GDP, government debt to GDP of 40%. In the past few years, we have been borrowing both domestically and externally to finance recurring deficits as the export earnings have declined. Therefore, again, an opportunity for the markets here, the likelihood of us increasing that statutory limit to probably the SADC limit of 60%. Alongside that, it's obviously to undertake several reforms around the debt market in terms of the range of bonds that we allocate, in terms of the payments infrastructures and so forth, to ease performance of the market. And those reforms are gaining traction, again to facilitate the debt market for Botswana. As I indicated, we recently had some downgrade in terms of the credit ratings by both Standard & Poor's and Moody's, but Botswana's rating remains very much investment grade. And while the downgrade reflects weakened fiscal position or weakened buffers, they recognize the strong institutions and credible policy frameworks that continue to anchor macroeconomic stability for the country. We are undertaking reforms, transformation reforms, anchored on what we call the Botswana Economic Transformation Program. This is being undertaken through the help of a Malaysian entity, Pemandu, that is helping us undertake these reforms in several areas, in several projects involving digitalization, involving the energy sector, tourism, agriculture, and the like. The important thing to emphasize around this transformation agenda is that it is very much intentional, it is focused, intended to deliver quick results and premised on quick execution, and also private sector participation in terms of the projects in those various areas that are indicated in infrastructure as well as social services. So private sector investment is very much welcome in these areas, aligned to also government involvement. And there are several regulatory reforms also associated with that, again suggesting that investments will be facilitated through intentional regulatory reforms to facilitate our economic transformation. So essentially, my message was that we are facing challenges, but those challenges, we want to turn them into opportunities to recalibrate our economy so that we get enhanced private sector participation that delivers tangible results in terms of industrialization, in terms of future high economic growth. I thank you.
Governor, appreciate it, as well as the correction. Yes. Thank you. I think the Deputy Governor deserves another round of applause, right? Not only is Botswana open for business and many of our peers across the continent, but lunch is also served. We would like to request your presence back here at 1:45, 2:45, 2:45. At 2 o'clock promptly, we do have a robust panel discussion, and 1:45, I beg your pardon. See why we all need lunch. 1:45, so lunch will be just over 30 minutes of engagement. It will be served in the main foyer. Please do engage. At 1:45, we will be back in the main plenary to ensure that we can commence the program at 2 o'clock with a discussion. Please do be mindful that this is where the Group CEO, Sim Shabalala, will be in conversation with the 8th Secretary General of the UN, Mr. Ban Ki-moon. So that is one of the highlights that we're looking forward to participating in today. We'll tie in many of the themes we've heard of today in many more conversations, but ladies and gentlemen, let me not keep you any longer. Lunch is served. Please be back at 1:45. Thank you so much.